Of course, just because a PPA provides fixed prices and therefore mitigates the revenue risk faced by generators, it does not necessarily mitigate profit risk, any more than government-provided, fixed-price feed-in tariffs themselves do. Such fixed-price instruments certainly assure generator profitability if actual construction and financing costs are broadly in line with, or lower than, those projected at the time of the project being scoped. But costs can change. Certain developers that had entered into contracts with Massachusetts utilities to develop wind power off the coast of that state, for example, subsequently saw rapid inflation in raw material costs and interest rates before being able to actually raise the necessary finance and purchase turbines, let alone begin installation work. Now, the projects look distinctly unprofitable, fixed prices or no, and one such developer, Avangrid, a subsidiary of the Spanish energy giant Iberdrola, filed a motion in late 2022 to have a signed contract annulled. Indeed, it did so precisely on the ground that the state's legal threshold for such PPAs, that they should facilitate financing, was no longer met. The motion failed. That Avangrid was willing in mid-2023 to pay its utility counterparties nearly $50 million to exit that particular contract is a measure of just how unattractive its terms had become. Essentially, such instances represent the inverse of what we saw happen in Spain in 2007-10, when, from Iberdrola's perspective, the shoe was on the other foot. Long-term fixed-price output deals, whether with government or with market actors, internalize assumptions about generators' likely costs. If those assumptions prove substantially erroneous on the high side, the result is likely to be windfall generator profits. If the assumptions are erroneous on the low side, the result is likely to be the opposite. In any event, in incorporating fixed prices, the likes of the Massachusetts offshore contracts were, as we have seen, very much exceptions to the rule. Fixed prices on renewables PPAs, at least in the global north, are largely limited to the corporate offtake market. Meanwhile, if, from the generator's perspective, the superior bankability of such corporate PPAs versus their utility counterparts is indeed rooted principally in the phenomenon of fixed pricing, it also has an additional significant dimension. As we saw earlier, utility PPAs are generally baseload PPAs, whereby the off-taker contracts to purchase a specified volume of power. Corporate PPAs, by contrast, are usually pay-as-produced contracts, meaning that the buyer takes all, or a fixed percentage, of the generator's power output, no matter what the production profile is. Again, Fosen and Tel-NS are cases in point. 32. The significance of this? Under pay-as-produced deals, the generating facility assumes no trading risk. But baseload deals are another matter. If the generator fails to meet the specified demand because, say, wind speeds are too low, it must acquire the shortfall on the spot market, where, of course, the price is unpredictable. While debt can be raised on the back of such baseload PPAs, one investor has explained, it is inherently risky for the bank since the seller needs to be able to show that he can properly trade the market and buy electricity when his project is not producing. This is not something all developers can do, so it makes project finance more challenging. 33 Not usually being baseload deals is thus another reason why lenders prefer corporate PPAs, and why generators share that preference. Essentially, then, in places where corporate PPAs have increasingly supplanted utility PPAs as a route to market for renewables generators, it is in large part because they are inherently the more bankable type of agreement. But it is worth noting, too, that the superiority of the former from the perspective of the generator has been further reinforced all the while by a gradual but unmistakable deterioration in the quality and scope of the opportunity afforded by the latter, for all that exceptions such as in the U.S. offshore landscape do exist. For a variety of reasons, there simply are, for one thing, increasingly few utility PPA offers on the table. Already by the mid-2010s, the UK PPA market, for example, had reportedly seen the almost complete withdrawal of the large. 34 Furthermore, those few utility offers that have remained on the table have themselves tended to become less attractive to generators. One reason for this twofold trend, not just in the UK but internationally, and especially in global North territories, has been electricity retailers meeting the renewables targets set for them by governments. If new such targets are not set, a primary motivation for retail suppliers to enter into bilateral contracts with wind or solar farms disappears. Another reason has, as it so often does, to do with credit constraints. Credit rating agencies have adopted more stringent treatments of the balance sheet liabilities that, for off-takers, long-term PPAs represent, and electricity resellers have adjusted terms, unfavorably for generators, accordingly. In what specific way or ways have the available utility PPAs become progressively less attractive to renewables generators, thereby further militating against the bankability of such contracts? There are two principal, linked answers to this. The first relates to pricing. As we have seen, utility PPA off-takers have always been reluctant to offer generators price stability. Where they have done so, it has usually been in the form of floor pricing. But, over the years, terms have become even more parsimonious, particularly on deals with anything other than very limited duration. One UK electricity supplier, for instance, acknowledged that whilst our short-term PPAs remain competitive, the structures we can offer for long-term PPAs have become increasingly restricted. 35. The linked aspect of the deterioration of terms on utility PPAs concerns contract duration itself, which has widely shortened. In India, for example, in an environment of underutilized and unutilized generating capacities, a growing trend for DISCOMs to offer shorter PPA terms was reported as early as 2016.36. The following year, in the US, it was likewise reported that utility off-takers that had previously offered solar developers generous long-term contracts were now offering shorter-term fixed prices with a higher subsequent exposure to variable wholesale prices. 37 Today, globally, utility PPAs are usually characterized by shorter contract periods than corporate PPAs. 38. Of course, all of this is highly contingent on the local industry and regulatory context. Are corporate PPAs even allowed? Do Amazon, Google, and the other big tech companies, which represent the main buy-side participants in the corporate PPA market, operate server farms in the countries in question? And, more significantly perhaps than anything else, do other meaningful mechanisms exist to fashion the price and revenue stability that is so consequential to generators and their financial backers? From the perspective of the latter, there is much less need for a fixed price PPA if, for instance, feed-in tariffs are readily available. Thus it is exactly as one would expect that corporate PPAs have generally been less notable a phenomenon in places where government support schemes for renewables explicitly offer price stabilization than in either, first, places where little meaningful external support of any kind has been available, or, second, those where such support is available but does not actively stabilize output prices. We can briefly consider three example countries, one in each of these three categories, to help make the point. The UK, with its long-standing, price-stabilizing feed-in tariff and then contracts for difference schemes, is an example of a location where corporate PPAs were long relatively marginal, because largely unnecessary. 39 It is noteworthy, and readily explicable, that the UK's corporate PPA market only began to show significant signs of life, principally onshore, when, from 2018, solar and onshore wind were cut off from the main aforementioned government support schemes, which were then reoriented towards offshore wind. Sweden, by contrast, has long been a significant market for corporate PPAs, partly by dint of a historically rather ineffectual government support scheme. Unlike much of the rest of Europe, Sweden has not provided support through feed-in tariffs or other such stability-oriented subsidies. Instead, such support as has been proffered to renewables generators has consisted principally of the incremental revenue that they are able to generate by selling clean energy certificates. In practice, however, this has amounted to decidedly thin gruel. Market prices for renewable certificates in Sweden have been low almost from the start, thus greatly augmenting the value to local wind and solar generators of instruments such as corporate PPAs, while also helping to explain the particular profitability challenges faced by the country's renewables sector. Lastly, the US is an example of the final country type. It has, of course, historically offered very generous tax subsidies, but, as we have seen, these, unlike feed-in tariffs, do not stabilize power prices. Hence, in part, the long-term buoyancy of its corporate PPA market. Indeed, corporate PPAs have frequently served to render bankable U.S. renewables projects that are also supported by tax equity financing and investment or production credits, but which would likely not have proceeded without the PPA. 40. In any event, in 2022, in the context of increasingly volatile domestic wholesale market prices and thus an augmented desire for mechanisms of price stabilization among both renewables generators and large corporate energy consumers, the corporate procurement of clean energy in the U.S. under long-term PPAs reached a record high of 20 GW. The details of the deals that made up this 20 GW provide an illuminating and instructive snapshot of the basic complexion of the world's single largest and most important corporate PPA market at the time of this writing. 41. Solar dominated the market, accounting for around 80% of the newly contracted capacity. In terms of deal structure, synthetic PPAs were similarly dominant, representing some 85% of deal activity. Meanwhile, just as overall contracted capacity was larger than ever before, so too, at 178 MW, was the average size of the newly announced PPAs, of which there were 112 in total. Finally, and emblematically, Amazon continued to tower over the rest of the sector. Around 50 different off-takers signed corporate PPAs in the US in 2022, but Amazon alone, with deals in 16 different states, was responsible for over 40% of the new capacity. V. Notwithstanding the considerable variance from place to place enumerated thus far, the crux of the trend of the past decade or so is nonetheless crystal clear. Corporate PPAs have increasingly come to represent an integral component of the global landscape of renewable power, and especially its financing. Even China is now on board. In 2022, for example, in one of the first major deals of the kind in the country involving two foreign actors, Canada's Brookfield Renewable signed a 25-year contract to supply electricity to the German multinational chemicals producer BASF's Zhanjiang Verbund site in southern China, using that contract as the basis for the local development of a suite of new solar and wind farms. In fact, already by the mid to late 2010s, in places such as Norway, Sweden, and large parts of the US where spot markets reign and other sources of price stabilization are absent, corporate PPAs had become nothing less than essential to make projects bankable. In the words of the professional services firm DLA Piper. 42, we have, of course, seen direct evidence of this essentialness ourselves. Neither Fosen nor TEL-NS would have gone ahead without their PPA agreements being in place. Conversations held with numerous European-based bankers in 2021 amply confirmed this growing essentialness, and for a widening range of territories. The statement by one such banker, whose firm finances solar and wind projects continent-wide, that we are generally only funding projects that have corporate PPA contracts, was broadly representative. 43, where there are no subsidies, conceded the executive of a firm that advises renewables developers on raising finance. Developers and banks have to look to corporate PPAs. 44. This actually existing significance is certainly one reason for us having discussed PPAs, and especially corporate PPAs, at some length in this chapter. But it is not, in fact, the main reason. The primary reason why corporate PPAs are so significant to the argument developed in this book has to do less with the role that such agreements have played in electricity markets historically than with the role they increasingly are expected to play in future. This warrants elaboration. For all that an energy transition led and steered by private capital and market mechanisms is, by any reasonable climate measure, failing, the powers that be continue to believe and maintain that markets and the private sector remain our best bet. Some such protagonists merely take this on faith. Others, however, do seek to provide substance to justify the belief in the transformative power of markets and capital, and, increasingly, corporate PPAs feature centrally in the arguments they make. This, ultimately, is why such PPAs matter for our purposes, in view, that is, of the way in which, and growing frequency with which, the corporate PPA phenomenon is invoked explicitly in support of a status quo approach to the management of the climate crisis, and more specifically to the fashioning and management of the energy transition that the crisis demands. Indeed, for many champions of the view that the energy transition, and especially the transition to renewable electricity, should remain capital and market-led, corporate PPAs have come to represent something of a great white hope. Of course, many experts and policy makers see no need for such a quasi-messianic appeal. For them, government support has by and large done its job. Historic subsidies to the solar and wind industries have catalyzed vast investment in cell and turbine technologies, leading in turn to steep falls in technology costs and increasing cost competitiveness with fossil fuel-based electricity generation. The market, in short, by this way of thinking, can manage relatively comfortably without external support now that cost is no longer an obstacle. The only substantive obstacles that remain are, so the argument goes, extra-economic. That so many powerful people and institutions subscribe to this view is not surprising, given the dominance of the cost-focused narrative. But not everyone has been blindsided. Other policymakers and experts possess a surer understanding of the economics of electricity generation and distribution. In particular, they know, while costs have indeed declined, that wholesale prices are volatile, that generator profits are unpredictable, and that renewables investment is, as a result, uncertain. Such persons tend to be far less sanguine about the likely pace of the ongoing energy transition, even as they generally have a preference for the transition to remain in capital's and markets' hands. It is among precisely such people and institutions that corporate PPAs have arrived on the industry scene as something of an apparent godsend. If, as appears to some extent at least to be the case, corporate PPAs can provide renewables developers with sufficient expectation of revenue stability to enable them to secure affordable financing, then might they be a silver bullet? Might they even enable policymakers to remove what government supports remain, or at least give such policymakers reason to believe that doing so will not unduly jeopardize ongoing investment in new renewables capacity? Fervor around the potential ostensibly harbored by corporate PPAs in this regard has been building for a number of years. In 2020, for instance, the consultancy KPMG captured the zeitgeist in the following terms. While the recent growth of global corporate PPA volumes has been steep, its consultants wrote, it is expected this is just the tip of the iceberg. 45 considerations in particular stoked KPMG's optimism. On the offtake side, the firm anticipated increased demand for renewables by corporations driven by their renewable energy sourcing targets. On the generator side, with a further decrease of government incentives with respect to renewable energy projects, it appeared inevitable to KPMG that risk-mitigated corporate PPAs will be required for developers to be able to attract competitive financing and realize new build of renewable generation assets. This combination of elements, the report concluded, will likely further catalyze growth of global corporate PPA volumes in the coming decade. Corporate PPAs, by this increasingly common reckoning, represent the private sector at its entrepreneurial, creative best, fixing the climate problem itself as the government progressively withdraws. Insofar as corporate PPAs effectively substitute for government support mechanisms as the principal source of investment bankability for renewables, such contractual instruments are, advocates infer, proof positive that a fundamental transformation of society's approach to infrastructure decarbonization, such as decommodification of the means of energy generation and distribution, is not needed. This, essentially, is the wider wager that market ideologues and other opponents of system change hang upon the struts of the corporate PPA phenomenon. In short, a renewables future free of government support is, in fact, viable. Thus, while the energy transition towards renewables has been enabled by government through support mechanisms such as feed-in tariffs, DLA Piper declared in 2019, as if announcing the crossing of a Rubicon, the baton has now, for the most part, passed into the hands of the private sector. And, with the market for corporate PPAs, the principal price hedging tool for both project sponsors and private off-takers, roaring ahead in the shape of what was described as a deal flow boom, the private sector, DLA Piper surmised, was succeeding admirably. 46. Perhaps predictably, the step from experts predicting that corporate PPAs could ensure renewables' continued bankability if governments withdrew support, to experts effectively advising governments to withdraw support on exactly such a premise, has been only a short one. In the same year as KPMG reported on the market, for example, the consultancy Baringa Partners produced a report on corporate PPAs for the Irish government. 47. The report positively brimmed with enthusiasm, specifically on the ground that this was indeed the market's own fix, obviating government financial backing to renewables. Corporate PPAs, Baringa explained, represent for renewables generators a market-led route to market which does not rely on state support. More exactly, they represent the primary market instrument used in liberalist power markets to underpin project debt financing of subsidy-free renewables. 48. If the Irish government needed any further encouragement in its avowed intention of making the facilitation of a thriving corporate PPA market one of its main policies for achieving a renewable share of electricity generation of 70% or by 2030, then this report, in no uncertain terms, provided it. The following year, the rosy vision conjured by the likes of Baringa, DLA Piper, and KPMG, namely of a market-led energy transition hinging substantially on corporate renewables PPAs, was effectively rubber-stamped by the world's leading prognosticator of global energy futures. An increasing proportion of utility-scale renewables growth in most markets, the IEA confidently proclaimed, is expected to come from corporate PPAs. 49. It was the clearest sign yet that the corporate PPA has been officially installed both as a substantive linchpin of the transition to a decarbonized power system and, accordingly, as a recursive validation of the market's ability to deliver that transition. Little wonder, then, that the corporate PPA was never far from the conversation when, in 2022-3, commentators and policymakers were forced to reckon with the implications of one of the deepest and most broadly based energy crises for a very long time, and with the question of what the crisis meant for energy transition scenarios. The steep escalation in electricity prices experienced in 2022 in Europe, in particular, led to widespread calls for deep-seated reform of electricity markets. When it eventually came, however, the proposal of the European Commission for such reform was, at best, limp. 50. No major redesign was needed after all, the EC evidently decided, either to protect consumers from the kind of price volatility seen in 2022, or indeed to maintain momentum in renewables growth. Why not? In large measure, because it was felt that the corporate PPA would enable Europe to pull through. Essentially, as the EC saw it, the problem the continent faced was not in fact poor market design, but rather that of member states not allowing markets, and especially corporate PPA markets, properly to flourish. 6. On numerous grounds, such positivity around the present and future role of corporate PPAs in electricity decarbonization seems deeply misplaced. Let us consider some of the main reasons for skepticism. Partly, there is an obvious political concern. To many, relying on markets and the pricing mechanism to drive the transition away from fossil fuels, which, in terms of broad approach, is what the world widely and increasingly is doing, is itself problematic enough. Markets are not only impersonal and faceless, they are also unaccountable. Should not someone, or rather some democratically elected institutional collective of someones, be taking responsibility? One of the big problems, Surely, with market coordinated processes is that people cannot ask markets why they are doing things in a certain way. Nor can people ask markets why they messed up when things go awry. Market mechanisms preclude accountability. But arguably, relying on a small coterie of big tech companies, and their idiosyncratic energy purchasing habits, to drive the transition away from fossil fuels seems, in political terms, even more problematic. One can quite imagine that, for many environmental and anti-monopoly activists, perhaps the only thing worse than nobody being responsible for driving and shepherding the energy transition would be Amazon, of all firms, being so responsible. Yet, to the degree that corporate PPAs are indeed being called upon to supplant government support mechanisms in catalyzing renewables investment, this, effectively, is more or less the reality with which we increasingly are faced. It would be difficult to conceive of a more ironic statement on the warped political economy of contemporary green capitalism. An especially bitter irony in this regard is the fact that those firms today enjoying the best publicity vis-a-vis their electricity purchasing habits happen to include some of the worst corporate offenders vis-a-vis carbon emissions. Take Amazon itself, the biggest of the procurers of clean electricity under corporate PPAs. On the one hand, buying such renewably generated power is certainly helping to reduce the relative carbon intensity of its operations, which it quantifies in terms of CO2 emitted per dollar of sales. But, on the other hand, its business, and especially its energy-gorging cloud computing web services business, has been growing so quickly that its absolute overall carbon footprint, which is what ultimately matters, continues rapidly to grow. 51. Another reason to be skeptical of the eager hubbub around corporate PPAs relates to the question of so-called additionality. On the generator side, corporate PPAs are signed not only by companies wanting to develop new generating facilities, and which regard such an agreement as a source of leverage with lenders in terms of unlocking construction financing, they can also be signed by companies with existing operational generating assets. In the latter case, the signing of a corporate PPA does not signify the accumulation of any new renewable generating capacity. There is, in the terminology of the sector, no additionality, and hence any claims to positive climate contribution on the part of the relevant off-taker ring rather hollow. Buying extant green power is simply not the same as helping to enable investment in new green power. DLA Piper has noted that much of the early activity in, for example, the UK's corporate PPA market represented agreements to purchase power from wind or solar facilities that had already been built, no fewer than 18 of the 26 reported deals that had been signed by 2019, to be precise. It did also note that, by the late 2010s, the focus of UK corporate PPAs was finally shifting towards enabling new capacity to come online, for example facilitating the financing of a subsidy-free greenfield project that would otherwise not have been built. 52 Moreover, many of the most active corporate PPA off-takers globally increasingly require evidence of additionality from generators before they will enter agreements. Nevertheless, concerns around additionality, or rather a paucity thereof, have not disappeared, and historically at least they have clearly had significant substance. But far and away the most significant reasons for caution concerning corporate PPAs, and especially with regard to their putative potential to drive broadly based future growth in renewables investment, are economic. The key issue here, simply stated, is that there are few credible, bankable off-takers, far too few to enable corporate PPAs to power the renewables market at large. The same issue, notably, has long plagued the parallel, longer-standing utility PPA sector. By their very nature, long-term bilateral PPAs of any kind entail massive counterparty risk, on both sides. The off-taker is essentially wagering that 5, 10, or 15 years down the line, the generator will still be in business and able to deliver the contracted amount of power. The generator, for its part, is wagering that, equally deep into the future, the off-taker will still be in business and still willing and able to purchase the contracted amount of power at the contracted price. How has this counterparty risk influenced the ability of companies developing new renewables plants to strike deals with electricity resellers to the satisfaction of lenders? Naturally, it has constrained it. Typically, lenders have only been willing to finance projects backed by utility PPAs if the off-taker is very large, very established and perceived to be very creditworthy. Smaller suppliers have, historically, been unable to play a significant role in providing long-term PPAs to new-build utility-scale renewable energy projects, consultants wrote in a 2013 report for the UK government. This, they went on, is because lenders tend to find it difficult to get comfortable with the credit risk given limited balance sheets and small retail positions. 53. Precisely the same constraints today encase the corporate PPA market. What do the banks that finance renewables projects look for in a potential corporate off-taker? A company willing to pay a decent electricity price, certainly. But not only that. Bankers operating in this space emphasize both the value of the revenue stream and the perceived security of the revenue stream. 54 The latter, as Yannick Rack has observed, principally means a large and bankable balance sheet, and typically an investment-grade credit rating. 55. Indeed, as one solar trade association has noted, a lower price from a very secure creditor may be worth more than a high price from a less creditworthy counterparty. 56 Corporate off-takers that present only limited credit risks in fact serially take advantage of this to negotiate for lower electricity prices in PPAs than their riskier peers are able to negotiate. More generally, to be deemed credible as a long-term PPA off-taker, a corporate consumer must have both sufficient power consumption requirements to be able to commit to acquiring all or a significant proportion of a project's electricity output, and sufficient commercial robustness to be likely to still be in business in the later years of a contract of a decade or longer duration. The upshot, inevitably, is that the universe of corporate off-takers considered suitable by renewables generators and by those that finance them is inherently limited. It's not at all easy to find viable corporate PPA purchasers, one fund manager conceded in 2021.57. In fact, in 2019, Aurora Energy Research estimated that companies covering only 14% of industrial power demand in the EU would be able to absorb the long-term power price risk involved in a typical corporate PPA, while also possessing the kind of credit rating required by lenders to PPA-backed renewables projects. 58. This does not mean that lenders never back projects on the basis of PPAs signed with somewhat less credible corporate off-takers. They sometimes do, just, as we have seen, as they sometimes back projects exposed to a degree of merchant price risk. But, as in the case of the financing of such merchant projects, when banks finance projects selling bilaterally to corporate consumers that are only semi-credible off-takers, they demand their pound of flesh. The risk, they say, is higher, and so, therefore, must be the cost of capital. 59. The key issue in all this, needless to say, is that the dearth of robust, credible, and bankable off-takers for corporate PPAs directly limits the potential size of the corporate PPA market, which is another way of saying that that dearth directly constrains the ability of the corporate PPA market to provide anything more than a marginal solution to the wider problem of renewables bankability. If the answer to the interconnected problems facing the renewables sector of uncertain profits, volatile spot markets and jittery financiers is to agree to sell the power produced by future solar or wind farms to an Amazon or Google, it is difficult to get past the fact that there simply are not so many Amazons and Googles out there. In fact, the obstacles are even greater than this discussion allows, because the shortage of credible off-takers also constrains the potential of the corporate PPA market to underwrite growth in renewables investment in a more indirect sense. As indicated earlier, the biggest, most sought-after corporate off-takers are able to drive down PPA prices because their perceived robustness is so highly valued by the counterparties to these agreements. 60 But they are also able to apply downwards pressure on prices on account of the very structure of the market. On the one side of the market there is an abundance of actual and aspiring generating companies seeking the bankability of a corporate PPA, on the other, as we have seen, is a paucity of viable purchasers. The market, in short, is highly imbalanced, and from relative scarcity itself comes negotiating leverage. In essence, the fact that there are so few potential electricity consumer buyers of scale to whom aspiring developers realistically can turn for long-term, fixed-price contracts is good for the former but bad for the latter and their financial backers. The consultancy McKinsey was alive to this phenomenon of market imbalance in as early as 2018. The market pricing of individual projects already reveals the typical characteristics of a buyer's market, it noted, with discounts of 15 to 35% compared with calendar forward prices 61. That is, to secure the revenue stability demanded by their funders, developers were having to accept PPA prices 15 to 35% or below prevailing wholesale market rates because there was insufficient competition on the buy side to push prices up. In 2021, a European asset manager with a substantial portfolio of renewables generating assets had something similar to say. Corporate PPAs in the Nordics, the manager observed, are being priced at something like €25 to €30 per MWh. But owners need €35 to €40 to make a decent return. So why are PPAs being sold at such a low price? It feels like buyers are getting a really good deal, and owners are getting poor terms. The obvious explanation, this individual concluded, is mismatch between demand and supply. 62. The companies benefiting most from the corporate PPA market being a buyer's market are, of course, the big tech companies mentioned above. As two industry experts explained to the Financial Times, the Amazons and Googles of the world are effectively able to bend the corporate PPA market to their own demands. The tech companies really do dominate the whole market from a size perspective, one said. Their influence is huge. These guys have a lot of market power, confirmed the second. 63. Specifically, such companies uniquely have the power to make, and not passively take, price. Amazon and the like get really good deals, one banker to renewables developers gloomily observed. 64. Another industry expert described in the following terms how the tech titans wield and exploit their market power in practice, and how their actions then ripple through the rest of the value chain. The big tech companies are driving the whole sector. They run auctions to get the lowest tariff that they can for 10 to 15 years. Developers jump on it, and then try to get the maximum amount of debt on the best terms, using the tech PPA as leverage. 65. Whether, and at what cost, clean energy capacity gets built always depends on the terms on which its output will later be brought to market, and this statement represents an especially striking testament to that fact. The threat that such aggressive pricing of corporate PPAs poses to growth in renewables development is, of course, that developers will not in fact build solar and wind farms and, ultimately amounting to the same thing, that banks and investors will not finance new such facilities, because the terms of corporate PPAs are simply not attractive enough, because, that is, the market power of Amazon, Google, and the like squeezes developer and financier profitability too far. The asset manager who bemoaned corporate PPAs in the Nordic region being priced at €25 to €30 per MWh in 2021 implied that the point at which developers, financiers, or both perceive insufficient scope for profit to justify the risk of investment, was already close to being reached. Thus, we are back again to the critical question of economic returns. Essentially, the same asset manager put it, Google and co are profiting from investors' desperation to go green. 66. But how desperate to go green are asset managers and other financial investors? This is, surely, the pivotal question, to which we have already gestured at various points. If the price of going green specifically via PPA-backed renewables investments is indeed lower returns than are available from alternative investment opportunities, growth in the PPA market will perforce depend upon financial institutions' willingness to accept those lower returns. As we have said, however, such willingness is anything but unlimited. All of which is to say that, for all the hype, corporate PPAs, as mechanisms of de-risking of investment, demonstrably represent a highly imperfect substitute for effective government support instruments like feed-in tariffs. Asked to speculate about the extent of likely future growth in the corporate PPA market, one banker opted for a blunt, one-word answer: finite. 67 Such caution is well warranted. If the corporate PPA is indeed the best solution to bankability that the private sector and the market can come up with, then market failure is quite clearly what we are looking at. 7. Before moving on, let us briefly take stock of where we are at in our examination of the political economy of renewables investment, in terms of key learnings about how such investment is rationalized, financed, and delivered. The previous few chapters, and this one, have taught us 5 main things. First, we know that what ultimately determines whether solar and wind farms get built or not is not price, relative to that of other technologies of electricity generation, but profit, and, more particularly, expected profit. Is the investment expected to yield an economic return that the developer deems acceptable? That is what matters. Second, we know that the relationship between price and profit is anything but straightforward. It would be easy to imagine that the cheaper it becomes to generate electricity, the more profit the generator will earn. But it would also be wrong. This was the lesson of Chapter 5, there is no straightforward such relationship, and thus even if solar and wind power are now cheap, it does not mean that profit-maximizing actors in the field of power generation will necessarily privilege them. Third, from Chapter 6, we know that in the type of electricity sector that dominates the global north, and towards which the rest of the world is indubitably shifting, which is to say, a sector in which electricity is predominantly traded in spot markets using merit order dispatch, renewable generators' expected profit is highly uncertain and unpredictable because wholesale prices are highly volatile. This, as we saw, represents a significant challenge to the bankability of proposed new capacity investments, at least in the absence of explicit mechanisms of price stabilization, of which government support schemes historically have represented the primary and most successful examples. Fourth, we know that, for a variety of reasons, but in particular due to low barriers to entry and thus relatively high intensity of competition, profitability in renewables generation is not only often unpredictable but also, typically, very low. In the brief, infrequent periods during which strong returns are achievable, capital floods in and swiftly pushes profit margins down. This was the thrust of Chapter 7, which also showed that there lurks in the background an arguably even more existential threat to renewables profits: price cannibalization. Fifth, and finally, the current chapter has shown us that, as governments, convinced by the power of price in driving renewables investment, move to reduce or discard, or at least to pledge to reduce or discard, existing state-sponsored support mechanisms, the market has come up with one possible substitute: the much-fated corporate power purchase agreement. But the chapter has also shown that the potential for the substitute to drive future renewables growth is, in reality, very limited. Given all of this, then, the question we need to ask is, what is actually happening on the ground today? If profitability is not in fact propitious, and if PPAs are not in fact the silver bullet many imagine them to be, to what extent is new capacity investment taking place? And how successful are market-favoring governments proving to be in consigning subsidy schemes to history? These are the questions taken up in Chapter 9. 9. Stuck on support. The mid to late 2010s marked a seemingly auspicious moment in the history of the political economy of renewable energy. Having long been considered too costly to be able to compete with fossil fuel-based technologies of electricity generation on a level playing field, the costs of solar and wind power had by now declined to a point where this long-standing common sense began to be widely questioned. A new common sense thereby emerged. If not everywhere and under all conditions, some new solar and wind facilities, at least, could, it was argued, be developed without explicit mechanisms of support. It was time for renewables to try to stand on their own 2 feet. And evidence soon emerged that seemed to suggest that indeed they could. Policymakers and renewables developers began to make announcements heralding pioneering support-free, or zero support, commercial, utility-scale wind or solar plants. Many of the first such declarations emanated from the United Kingdom. A number of firms publicized plans to develop support-free UK facilities from as early as 2016, among them Good Energy and Lightsource Renewable Energy. The first such purported facility to actually open for business was the 10 MW Clayhill Solar Farm in Bedfordshire, which was developed by Anisco and began generating power in September 2017. For the solar industry, averred Anisco's chairman, Clayhill is a landmark development and paves the way for a sustainable future, where subsidies are no longer needed or relied upon. The following year, another, much bigger, first was hailed. The Swedish energy company Vattenfall announced that it was to develop the world's first subsidy-free offshore wind farm, the vast Hollandse Kust Zeewide scheme, around 20 to 30 kilometers off the Dutch coast between The Hague and Zandvoort. At the time of the announcement, HKZ was envisaged as a 750 MW facility, to be built by 2022. The schedule has subsequently slipped, while the scale has expanded and new co-owners, Allianz Capital Partners and BASF, have been brought on board. Numerous similar proclamations have followed over the ensuing half-decade. Situated predominantly, but not only, in Europe, these have ranged from Germany's first zero-support solar farm to China's first zero-subsidy wind farm, construction of each of which began in 2019. Just one short decade earlier, Deutsche Bank's in-house environmental research and investment team had written a report that depicted an entirely different type of renewable energy world. The DB analysts calculated that the development of fully half of all installed solar and wind capacity in service worldwide as of 2008, and as high as 75% or in the case of solar, had been supported by feed-in tariffs, not government support mechanisms in general, note, but FITs specifically, and this even before countries such as China had turned to FITs as their subsidy mechanism of choice. 2. Little wonder, then, that when they surveyed the brave new world of zero support that seemed to be coming into being in the late 2010s, expert commentators often invoked odd, epical terms. I think the word revolution is befitting, maintained Matthias Rinsky of the energy research firm Aurora, because it is a marked departure from the old paradigm, where renewable deployment was driven by government intervention. This revolution brings a new paradigm, where decarbonization can be brought about by sheer market force. 3. The motive power of such sheer market force is, of course, precisely what the protagonists of our relative prices narrative, the argument that renewables ineluctably will win out, once the price is right, had long been insisting on, and indeed continue to insist on. In short, the price, it seemed, was now finally right. The demand for zero-support renewable electricity is booming, the energy journalist Julian Wedigel wrote in 2021.4. But is this actually true? Given everything we have learned in the preceding several chapters about both the very real economic hurdles to renewables investment that actually exist, and about the importance of various external support mechanisms in helping these hurdles to be negotiated, booming demand for zero-support renewables appears, on the face of things, to be surprising. So let us investigate. The geographical pattern of recent global growth in solar and wind generating capacity is very easy to describe. Figure 9.1 depicts this pattern visually. The key feature is that the addition of new capacity remains geographically concentrated to a striking degree. In every year since 2016, 3/4 or more of all net new solar and wind capacity globally has been installed in Europe and just 3 other countries, China, India, and the US. At the end of 2022, those regions held 81% of the world's installed and connected solar and wind assets, some 1.59 out of 1.95 TW of total global capacity. As the chart shows, China is utterly dominant. Not far short of half of all net new solar and wind capacity installed globally between 2017 and 2022 was installed in China. Remarkably, the proportion actually exceeded 50% in 2020, the surge in new installation that occurred in China that year, after a dip in 2019, is something we will discuss later in the chapter. The second most significant country in terms of recent capacity growth is the US. Though it lags a long way behind China, it is, equally, far ahead of any other individual country. Moreover, within the space of 3 short years, the amount of net new solar and wind capacity installed annually in the US more than doubled, from 15.1 GW in 2018 to 33.3 GW in 2021, although, as we will see, new US installations fell sharply in 2022. The final individual country for which data are provided in Figure 9.1 is India, and for the simple reason that during the period covered by the chart, it saw the third largest absolute net growth in new capacity, although it did not necessarily rank third every single year within that period. Nor, it is worth pointing out, does India today hold the world's third largest national stock of solar and wind capacity. It actually ranks fourth, behind Germany. But Germany's main growth in capacity occurred relatively earlier. Meanwhile, within Europe, the countries that in recent years have been expanding their renewables asset portfolios most rapidly are generally those that one might intuitively expect to have been doing so, namely the larger Western European nations, the likes of Germany, Spain, and the UK. But there are some important anomalies, or at least cases that someone with no knowledge of the often tortuous national political economy of energy provision might consider anomalous. Figure 9.1 Net annual growth in solar and wind capacity, selected regions, 2017 to 22. Source, IRENA. On the one hand, there are countries such as the Netherlands, which have been investing in solar and wind to a degree that far outstrips their relative size. More than 10% of the overall new renewable capacity added in Europe between 2017 and 2022 was installed in the Netherlands, a country of fewer than 20 million people. On the other hand, there are countries such as France and Italy, in both of which renewables remain marginal, albeit for very different reasons, and with very different implications for the climate. As explained earlier in the book, France has essentially bet the metaphorical house on nuclear, thus mitigating much of the need for a domestic energy transition specifically on climate grounds. But, in Italy, fossil fuels in general, and natural gas in particular, remain dominant. It is far more reliant on gas for electricity generation than any other major European country, unless, that is, within Europe one includes Israel, where coal and gas continue to supply almost all electric power. In any event, some of the countries that are clearly leading recent global investment in solar and wind power, China, Germany, the Netherlands, and the UK, also appeared on the above list of countries that have reportedly been pioneering zero-support renewables. We must, therefore, examine these particular national cases. But what of other major renewables investors? What, for example, of India? And what of the US? To what extent is the support-free phenomenon booming there, too? We will begin our survey in Europe, the undisputed heartland of the phenomenon in question. 2. Our first stop is Clayhill in Bedfordshire in the UK, which, as we have seen, was widely reported as being the country's first operational subsidy-free solar farm, and which started generating power in 2017. The facility even received a glowing mention for its apparent economic breakthrough in the government's annual State of the Energy Market Report 5. It was, evidently, considered a genuine milestone. Yet the reality belied the evangelism. Investigative reporting disclosed that part of, perhaps even the entire, reason why Anisco was able to develop Clayhill without using a formal government support mechanism such as a contract for difference was that the facility was able to exploit infrastructure that had previously been built, and paid for by others. 6. One important component of this pre-existing infrastructure was a battery storage facility that Clayhill would be able to use to store power for subsequent sale during periods of high demand. Anisco conceded that the storage facility was crucial in making Clayhill viable as a subsidy-free proposition. 7. Another important extant component was a grid connection. This existed because Clayhill was sited next to a solar plant of earlier vintage, which itself had benefited from a government subsidy. Essentially, then, this much ballyhooed new renewables facility was, in fact, subsidized by the UK government, only the subsidy was implicit, invested historically, and sunk physically and economically in legacy infrastructure, rather than explicit. Cunliffe's answer to the question he himself asked, how to build a solar farm without government subsidies, spoke volumes. In a nutshell, find a site where you can lean on existing infrastructure. Vattenfall's answer, in the case not of solar but of offshore wind, and specifically the Hollandse Kust-wide facility off the Dutch coast, was different, but nevertheless related. In HKZ, Vattenfall has indeed developed a new offshore wind facility without the support of a direct government subsidy, hence the labeling of the project as subsidy-free. That is, HKZ is not part of a formal subsidy framework such as SDE+, the principal scheme through which the Dutch government has in recent years supported renewable power development, a scheme aptly described by one report as a sliding feed-in premium structure, which takes away most, but not all, exposure to merchant price risk. 8. But, as at Clay Hill, there nonetheless clearly is a significant state subsidy to HKZ, and, once again, it pertains to supporting infrastructure. Specifically, Vattenfall and its partners have not been required to pay the costs of grid connection, which in the Netherlands are socialized. It's a good way of de-risking the project, Vattenfall CEO, Magnus Hall, told Carbon Brief. But it also means that is not fully subsidy-free, if you want to say so. 9. The Dutch government had also undertaken, and borne the costs of, all the site selection and other research that needed to be carried out before it could conduct the beauty contest through which the HKZ tender was awarded. 10. We should pause and expand at this point, because the socialization of the costs of grid connection is a form of subsidy with a wider applicability. One important reason why renewables developers such as Vattenfall do indeed regard such socialization as a form of subsidy, and why we in turn should do likewise, is that it is not universal government policy. While the governments of the Netherlands and certain other countries, including Germany, are willing to bear the costs of grid connection for certain categories of renewables developer, many other national governments are not, and hence, if development opportunities in the latter countries represent a baseline cost scenario, opportunities in the former clearly occasion a relative subsidy. Spain and the UK, for instance, are two significant examples of European countries in which the developer is itself required to fund the cost of grid connection, on the so-called allocation by cause principle. How significant a subsidy exactly is the state's selective shouldering of grid connection costs? It varies greatly and depends on the type of facility to be connected, and where. For onshore renewables plants, most studies suggest that grid connection accounts for in the region of 10 to 15% of total capital expenditure, a not insignificant proportion. But, in the case of offshore wind farms, of which HKZ is of course one example, the proportion, unsurprisingly, swells. Anywhere between 15 and 30% of the capital cost can go to grid connection. 11 And, as we have seen, for renewables generators, unlike fossil fuel-fired generating plants, upfront capital costs essentially constitute lifetime plant costs, or at least the lion's share. If, then, the government agrees through this mechanism to pay, say, a quarter of all your expected costs as an offshore wind farm developer, very clearly it is massively subsidizing you. The socialization of grid connection costs represents, in fact, one of two main forms of implicit government subsidy that continue widely to support what are only nominally zero support/zero subsidy European renewables projects. The other main such form of subsidy consists of certain types of CFD scheme, operating under certain market conditions. But, inasmuch as CFDs are typically understood to provide an explicit subsidy, this implicitness requires some explaining. A key distinction to understand here is between zero-subsidy project tenders and zero-subsidy bids. The tender through which Vattenfall was awarded the HKZ contract was an example of the former. It explicitly precluded direct subsidy, All the developers that entered the beauty contest were aware that the Dutch government was not offering any mitigation of wholesale price risk, whether through a CFD or any other scheme. Meanwhile, contrast such a tender mechanism with auctions for CFDs such as those which the Spanish and UK governments currently operate for specified renewables technologies. In these so-called reverse auctions, bidders bid prices down, and the winning bidder, offering the lowest bid, effectively receives a fixed price, as bid, for the duration of the contract period. Now, consider the crucial question of what the electricity spot price is at the time such a contract is awarded. If the spot price happens to be higher than or equal to the price bid and thus stipulated in the CFD, then this is termed a zero subsidy bid, at the time of the auction, and then for as long as the spot price remains equal to or higher than the contract strike price, the generator does not receive a direct subsidy. The auction mechanism made subsidy available, but the bidders competed it away. This is what happened, for example, when the Spanish government auctioned 1 GW of new wind capacity in January 2021. The winning bids ranged from €20 to €28.89 per MWh, hailed as the lowest ever prices for new wind energy in Europe. 12 That month's average electricity spot price in Spain was around €60 per MWh. But, of course, if, during the period covered by the CFD, the spot price were subsequently to fall to below €45 in our hypothetical case, then the generator would be in receipt of subsidy. This is why CFDs, FITs and comparable mechanisms arguably should always be understood as subsidies even if they do not look like subsidies, and indeed are publicly posited as not being subsidies, at the time of their contractual agreement, that is, because they promise to provide subsidy as and when the market requires it. The subsidy is implicit, rather than explicit, since it may not ever kick in. A widespread lack of understanding of these mechanisms leads to all manner of misinterpretations and misleading claims. Far from depending on subsidies, the ubiquitous economics commentator Adam Tooze, for example, announced in early 2023, European wind power now operates on such a profitable basis that it returns revenue to European treasuries. 13 Well, yes and no. Yes, some operators in that period were earning windfall profits as a result of energy crisis, induced wholesale price spikes and were returning some of these profits as windfall taxes. And, yes, spot prices were, at that time, higher than the fixed contractual strike prices that certain European wind operators had agreed with governments at tenders for new capacity, meaning that in those cases, money, equivalent to the spot price minus the strike price, indeed was nominally being returned. 14. But also, no. For one thing, the latter operators in question would of course duly receive subsidy payments in the event that the spot price dipped below their respective contract prices. More importantly still, had the guarantee of such eventual subsidy not been part of the contractual agreement with the government, the banks to whom the developers holding such contracts turned to raise construction finance likely would have run the proverbial mile, in which case the generating facilities that the agreements in fact helped render bankable would not have been built in the first place. In other words, the types of operators to whom Tooze referred do in fact continue, absolutely and intimately, to depend on subsidy mechanisms, even, paradoxically, if no actual subsidy is ever received. In order to get their operations off the ground, they require confirmation that subsidy will be paid if and when needed. Think of it this way. The Toozian argument that European wind power was operating without subsidy in early 2023 is analogous to saying that insurance schemes such as protection for bank depositors play no meaningful role in those periods during which no claims are filed and paid out. Both propositions are simply untrue. The mistake in each case is to presume that the support mechanism only applies ex post facto. But in reality, the role of deposit protection, as of CFDs, is not just to mitigate retroactively actual losses or revenue shortfalls incurred. It is as much, if not more, to provide, a priori, confidence in the existence of an eventual safety net, this confidence being required to summon the relevant actors, depositors in the first hand, renewables generators in the latter, to even participate in the relevant market. Both depositor protection schemes and price-contingent renewables subsidy schemes perform a crucial market-making function, irrespective of whether they ever actually pay out a single penny. Finally, for good measure, there was another awkward fact of which THIRD evidently was oblivious. The analysis to which he linked in support of his claim, and which showed newer offshore wind farms not at the time being in receipt of effective subsidy, in fact assumed that all grid connection costs were socialized. 15 That is, there was assumed to be subsidy, it just was not categorized as such. And, when the authors of the study in question instead allocated the grid connection costs to the respective project developers, the finding that THIRD trumpeted no longer obtained, no money was returned. Interestingly, when governments attempt to minimize the likelihood that the contingent subsidy afforded by CFDs and FITs ever will be required and paid, the attempt often backfires, and sometimes spectacularly so, a striking demonstration, in its own way, of the industry's ongoing need for support. The most common way in which governments do this is by imposing price caps at auctions. Consider what happened, for example, when the Spanish government auctioned up to 3.3 GW of wind and solar capacity in late 2022, soliciting project proposals for CFDs subject to a price ceiling of €47 per MWh. With developers' raw material and financing costs, not to mention electricity spot prices, having increased dramatically since the same government's wind auction in early 2021 attracted winning bids of below €30 per MWh, the new auction was an utter failure. Forstalia and L1 Energy were the only developers awarded allocations, these totaling just 45 MW, or around only 1.5% of cumulative tendered capacity. 16 A year later, the UK government managed to go one better, when its auction of contracts to deliver up to 5 GW of new offshore wind capacity, which likewise capped contract prices, attracted precisely 0 bids. It is also, of course, the case that a CFD such as those awarded by the Spanish and UK governments represents a significant external support mechanism, and one that crucially enables developers to raise finance, quite aside from any subsidy element that it vouchsafes but may or may not occasion. This is because it actively stabilizes revenues, such an important support factor, as we have seen, in liberalized electricity markets, like Europe's, with volatile wholesale prices. Not for nothing does the 2020 Spanish regulation setting out the country's current CFD framework focus specifically on this aspect rather than on that of subsidy. The main aim, the regulation explains, is to favor predictability and certainty, to encourage new investments in new renewable energy capacity. 17. And then there are power purchase agreements, another important potential source of revenue stabilization which can help fashion project bankability. Germany's first zero-support solar farm, the 8.8 MW BWARE facility mentioned above, was, for instance, not, in fact, a zero-support facility. Its financing and development were enabled by a long-term PPA with unnamed industrial customers that was announced at the same time as the construction plans. 18 Furthermore, as if the Dutch government's waiving of grid connection costs were not enough, Vattenfall proceeded to reinforce the viability and bankability of HKZ over the course of 2021 and 2022 by signing fixed-price, long-term corporate PPAs with the industrial consumers Air Liquide and BASF, thus adding stability to implicit subsidy. None of this is to say, however, that, at the outset of new projects, eventual project profitability is ever wholly certain in today's European renewables industry, for all that the industry indeed remains solidly buttressed by robust mechanisms of economic support. As we saw in Chapter 8 when we discussed recent wind power development offshore from the U.S. state of Massachusetts, the various types of advance offtake contract that developers commonly sign to mitigate revenue risk and enable capital raising can themselves rapidly become millstones rather than manna if conditions in equipment or financial markets move against the developer after such a contract has been signed but before equipment and capital costs have been finalized, however attractive the terms of the offtake contract may initially appear. This is seemingly what happened, for example, in the government-supported UK offshore wind market during 2022-3. Companies that perhaps thought they had struck gold when they signed CFDs for new projects with the UK government in 2022 were, by early the following year, warning the government that the projects would be difficult to deliver at the strike prices agreed. Such had been the rapid inflation in the costs of both finance and turbines. Overall projected project delivery costs had risen by an estimated 20 to 40% or in most cases, in less than 12 months. Ørsted and Vattenfall were among those reported to have lobbied government for 11th-hour investment allowances and other tax breaks to help revitalize schemes that now threaten to be loss-making. 19. As in Massachusetts, however, such appeals fell on deaf ears. The upshot: some projects came to a standstill. In mid-2023, for example, Vattenfall downed tools on the 1.4 GW Norfolk Boreas scheme, for which, 12 months earlier, it had signed a 15-year, inflation-linked CFD with a starting strike price of £37.35 per MWh at 2012 prices. "It's important to invest only when our return requirements are met," insisted Anna Borg, Vattenfall's chief executive, while booking an impairment charge of over $500 million. Meanwhile, Ørsted's own boss threw his support behind his competitor, describing Borg's decision to halt the development as courageous, imploring governments such as the UK's to realise that offshore wind ambitions will only happen with sane auction frameworks and realistic prices, and hinting that Ørsted might itself have to pursue similar measures. 20. The more general point is that where it is specifically revenue that in one way or another is controlled, renewables profits always remain uncertain until such time as the costs of construction and its financing have been locked in. To begin to sum up, therefore, we can say that the support on which Europe's renewables power sector remains demonstrably stuck comprises a complex and variegated mix of both subsidy and stabilization. Some projects enjoy one, for example subsidy, some enjoy the other, and some enjoy both. There are, it follows, two common fallacies that need to be dispelled. One is that there is no subsidy unless such subsidy is explicit. The cases of socialized grid connection costs and zero subsidy bid CFDs both give the lie to this notion. The second fallacy is that which conflates support with subsidy. This fallacy elides the significance of price stabilization. As Simon Peltenberg of the UK's Residential Group has put it, subsidy-free renewables does not mean support-free, or at least, it does not have to. 21 The evolving landscape of European renewables development is ample testament to this fact. Last but not least, across Europe it is clear that, having selectively experimented with attenuation of their packages of renewable support, governments, still far and away the main source of support for European renewables, whether that support incorporates subsidy or not, have increasingly come to appreciate the economic obstacles to effecting such attenuation without simultaneously subduing renewables investment, and are therefore typically now renewing and bolstering support packages, rather than doing the opposite. Germany is perhaps the most notable and significant example of this, with its new Renewable Energy Act of 2023 serving to extend support through to 2026. In the form principally of feed-in premiums for larger generators and feed-in tariffs for smaller ones. 3. That the U.S. landscape of renewable power generation also remains stuck on support is considerably plainer to see. For one thing, one searches in vain for evidence of U.S. support-free or zero-support renewables. Not a whiff of such a phenomenon can be detected. Furthermore, and as we shall shortly see, the long-term extension of direct government support for renewable electricity generation, successfully accomplished in 2022, has in recent years been an issue with very high political and public visibility. It would have been hard to miss. As we saw earlier in the book, U.S. government support for renewable energy generation has long been predicated predominantly on a system of tax credits, which work through subsidization rather than stabilization. For stabilization, developers must turn instead to fixed-price PPAs or financial hedging instruments such as swaps, which they often do in conjunction with tax credits, it is rarely a question of either/or. Ordinarily monetized through deals with third-party financial investors, the US renewables credits subsidize either construction, the investment tax credit, or generation, the production tax credit. The former has historically been utilized principally by solar developers and the latter principally in the wind sector, a product of the fact that the rules applying to the two types of credit have conventionally been different for different technologies. In the US, unlike in Europe, the essential nature of the main mechanism of government support for renewables generation has, to date, been notably consistent. Certainly, as we will see, rules and rates have periodically been tweaked. Moreover, to bolster the efficacy of tax credits, both federal and state governments have at times used various tributary instruments. But, in terms of the principal policy, there has been no flip-flopping between reliance on, say, renewables obligations and FITs. The core mechanism was tax credits 20 years ago and it remains tax credits today. As such, subsidy remains explicit rather than implicit. Nevertheless, the inclination that, with declining technology costs, solar and wind power should be able to do without subsidy, or, at the very least, with substantially less of it, has long been evident in the US no less than it has in Europe. Such an inclination is writ large in the fact that US policymakers have repeatedly legislated that renewables tax credits will be time-limited, or will be reduced in scale over time, or indeed both these things. In repeatedly so legislating, policymakers have signaled their conviction that the need for support is declining and will continue to decline. Indeed, when, in 2022, U.S. policymakers agreed on the most significant renewal and fortification of the country's renewables tax credits in a generation, in the shape of the Inflation Reduction Act, the same question continued to hang in the air, haunting the legislators' actions. As Eric Lipton posed the matter in the New York Times, were the revised credits in fact constructed in ways that reward companies for taking actions that market forces would lead them to take anyway? After all, Lipton said, renewables even without federal subsidies are now cheaper than coal, meaning that the market was already giving plenty of incentive to change how they produced power. Point 22 There was definitely a sense, a lingering inclination, if you like, that tax credits were and are a policy that should not still be necessary, but which somehow still are. Because, for all the aspiration, expectation and indeed legislation of subsidy attenuation, it has plainly not worked out as planned. In repeatedly hazarding withdrawal, the U.S., like the perennial junkie, has repeatedly failed, the IRA representing the latest and most dramatic failure. Exactly why the U.S. has failed to wean its renewables sector off support remains an open question. One relevant factor, to be sure, has been industry lobbying for support not to be withdrawn. As Lipton himself observed, for example, the successful passage of the IRA in 2022 was greased by significantly increased spending on lobbying and campaign contributions by the renewables sector, not least NextEra Energy, which by itself had around 50 registered lobbyists at the time. That those benefiting from the tax credit system include not just renewables companies themselves but, through tax equity financing, also big Wall Street banks, with all their famed lobbying clout, should not be underplayed, either. An attempt at an explicit answer to this why question is beyond this book's purview. But it is certainly within the book's purview to make a pertinent observation. Price volatility, low underlying profitability, and boom-bust dynamics are, in the U.S. renewables sector, long-standing historic facts. Whatever the influence of industry lobbyists, policy concerning economic support for the industry has been made and remade in this particular factual context. And given such a context, the direction that policy making has taken is, to say the least, hardly surprising. Ongoing maintenance of healthy support for renewables operators, encouraged by growing recognition of the significance of that support to sustaining investment appetites, is, actually, exactly what one would have expected. In fact, notwithstanding the relevance of lobbying, it should not go unmentioned that 2022 actually saw a significant decline in utility-scale wind and solar installations in the U.S. The 32 GW of new renewables capacity added to the grid was nearly 20% or lower than in 2021.23 There appeared to be several possible contributory factors, but, as Jennifer Hiller observed, a significant factor slowing installations was the uncertainty over the details of federal tax policy that pervaded the country until the IRA was finally sealed in August. 24 Other commentators concurred with Hiller's explanatory assessment. 25 Whatever else it represented, this episode of significant disinvestment throws cold water on the oft-heard theory, alluded to by Lipton, that the US renewables tax credits reward developers for doing things that, in view of renewables cheapness, they would now be doing without such support, by dint of pure market logic. In the first half of 2022, when nobody knew what the support framework was going to look like 12 months, still less 2 years or more, ahead of time, developers evidently did not do those things, at least not on anything like the scale of 2021. Had the fulsome subsidy support available historically in fact by this juncture become more or less immaterial, essentially rewarding developers unnecessarily, one would have expected investment to remain robust, regardless of what was or was not happening vis-a-vis tax credit policy. In any event, a potted history of the past 2 decades of the ITC vividly illustrates the dependency-like pattern of repeated failed attempts at withdrawal from the support drug. Although it had existed in one form or another since the late 1970s, the ITC only came to prominence in 2005 when the Energy Policy Act increased the subsidy to solar installations from 10 to 30%. This higher rate was originally slated to expire at the end of 2007, but no fewer than 3 times during the following decade it was extended, first in 2006, again in 2008 and then once again, through to 2019, in 2016. This last extension of the 3 was effected by the Consolidated Appropriations Act, which also legislated that the higher rate of 30% would then be phased out, with a 26% credit applying to facilities beginning construction in 2020, 22% to those entering construction in 2021, and 10% to those starting in 2022 or thereafter. Even this more moderate plan for attenuation, that is, gradually weaning the sector off subsidy rather than requiring it to go cold turkey, did not hold, however. In December 2020, Congress passed a 2-year deferment of the phase-down, meaning that the 26% rate was extended to the end of 2022 and the 22% rate to the end of 2023. As we saw in this book's introduction, many advocates of clean energy were deeply concerned during 2021-2 that this deferred phase-down would hold, and that solar developers would indeed have to make do with a 22% credit in 2023 and a 10% credit from 2024. For while President Biden was in favor of another, long-term extension, the Republicans, and the Democrat Joe Manchin, stood in his way in the Senate. But, at the 11th hour, the impasse was broken. The Inflation Reduction Act of August 2022 legislated a major renewal of all of the country's renewables tax credits, the ITC included. A brief overview of the new framework is worth rehearsing. Essentially, all credits were extended to 2033, with the value of the PTC being maintained and the ITC being restored to the full 30% subsidy. Moreover, 3 notable new provisions were introduced. First, utility-scale projects must satisfy apprenticeship and prevailing wage requirements to receive full credit value. Second, both the PTC and the ITC will be technology neutral from 2024, in other words, the rates and rules applying to each, which historically have differed as between different technologies, will be standardized. And, third, there is a direct pay provision. Historically, only entities with tax liabilities could claim the credits, which is why developers often have only been able to access the subsidy by transferring it to an entity with such a liability, typically a bank, in return for tax equity financing. but direct pay allows entities without tax liabilities, including non-taxable bodies such as public agencies, to benefit from the credits. Most experts expect that the 2022 strengthening and extension of the US principal mechanism of state support for renewables will have a substantial impact on the country's ability to achieve its climate goals. Researchers at Princeton's REPEAT project, for instance, estimated that, all told, the Inflation Reduction Act would see the U.S. cut its emissions by 42% on 2005 levels by 2030, with electricity generation playing the leading role, and this in large part due to the new tax credit framework. 26. Our own immediate interest, of course, is less in what this support framework will in practice achieve, than in what its materialization suggests about the contemporary political economy of renewable power. Certainly, the IRA makes a mockery of the argument, which, bafflingly, some high-profile commentators continued to make even after its legislative passage, that clean energy in the U.S. no longer requires political interventions for survival. 27. This is an adulteration of the truth. That external economic support for the development of solar and wind power, despite the historic cheapness today of such power, remains utterly fundamental to the renewables landscape is, ironically, perhaps clearer and more explicit in the U.S., the putative home of free markets, than anywhere else in the world. 4. In many significant respects, India's electricity sector looks very, very different from the US. Where the latter is dominated, depending on the region, either by territorially delimited, vertically integrated monopoly suppliers or by wholesale spot markets featuring unbundled power producers and distributors, the former is dominated by bilateral, long-term power purchase agreements between producers and distributors, through which the vast bulk of electricity is transacted. In other respects, however, there are important similarities, not least with regard to renewables. Most notably, the idea of zero-support renewable power is conspicuous by its absence in both, in India, as in the US, state support for renewables remains integral, and continues to be understood as such. This, pointedly, is despite India already enjoying the world's lowest weighted average total installed costs for renewables projects, some $618 per kW in 2019.28. In fact, as we will see, this is part of the problem. So much, in short, for the nostrum that cheapness somehow obviates economic support. What form or forms does such support take in India? Much discussion of Indian solar and wind power makes mention of the country's renewable purchase obligation scheme, which is designed to compel distribution companies to procure a minimum share of their power requirement from renewables generators. Attention to the scheme is understandable. Even as enforcement historically has been lax, the RPO certainly plays an important role. 29. Moreover, in recent years, the government has reaffirmed the importance of this mechanism, lifted targets, rising from 25% in 2023 to over 40% by the end of the decade, and, perhaps most significantly, created an RPO compliance cell, indicating newfound emphasis on adherence. Experts regard all this as being likely to provide further impetus to renewables development. 30. Nevertheless, the main form of support offered to renewables in India is long-term price stability. As mentioned, PPAs between generators and distributors, most of the latter being state-owned, provide the core scaffolding of the electricity market. In the case of PPAs specifically with solar or wind plants, these contracts historically used feed-in tariffs, priced on a cost-plus basis. In the 2010s, the country transitioned to reverse auctions for renewables contracts, much like across Europe. It is at these auctions that companies bid to establish new capacity, with the winning bidder being awarded the PPA. But, even if the method of price setting has changed, the contractual price form remains the same in terms of its essential characteristics. The price is fixed, and for the long term. While this framework supports and occasions investment in new renewables capacity, it is not without its difficulties. On the one side, rising equipment costs beginning in early 2021 are, as the IEA has noted, putting additional stress on developers who bid aggressively in auctions, betting on further continuation of earlier cost reductions. 31 There are echoes here of, for example, Avangrid, and the impact of similarly rising costs on the profitability of its own recently signed PPAs in the U.S. offshore sector. On the other side of the market, the financial health of India's DISCOMs has been parlous for a decade or more, and this has had increasingly deleterious knock-on effects in recent times for renewables investment. For one thing, as The Economist has observed, the DISCOM's lack of financial sturdiness unnerves banks seeking to finance generating companies, since such DISCOMs do not look like the safest of counterparties. 32 Furthermore, in view of their indebtedness, DISCOMs have been serially delaying signing PPAs with auction winners, thereby risking project postponement and even cancellation. Nor is the phenomenon of delays in PPA consummation just a matter of the DISCOM's particular financial straits. More significantly, perhaps, it reflects developments in the sector's economic fundamentals. Specifically, DISCOMs also delay signing new contracts because the medium-term trend in auction prices, in line with generator costs, has been solidly downwards, raising, as the DISCOM see it, the possibility, or at least the hope, that delay might allow for market-aligned price renegotiation. 33 Indeed, some DISCOMs have also been attempting to renegotiate the prices of contracts already signed. For all these reasons, policymakers, along with commentators both in and outside India, have been insistent on the need for continuing, even bolstered, sector support. That renewables' very cheapness has been a material factor in necessitating such renewed support is eminently paradoxical, but nonetheless true. What we have seen is effectively a variant on the phenomenon of price cannibalization. The Indian government has been required to reinforce its role in supporting the renewables sector because falling generator costs and thus auction prices raise expectations of more of the same, exerting a chilling effect on the willingness of off-takers to lock in prices that may in due course appear uncompetitive. Generators, too, have themselves been up in arms, urging the government to instead use closed bids when tendering for new renewables capacity. The reverse auctions currently used, the generators maintain, depress prices and hence their own profits, thereby constraining their appetite for further investment. 34 Though certainly not appeasing all parties, the government's response to these recent challenges has been relatively robust, taking two main forms. 35 First, it has provided support to the struggling DISCOMs, and by extension, one can add, to their generator counterparties, by effectively underwriting new long-term renewables PPAs. Second, it has provided increasingly valuable indirect subsidies to renewables generators by facilitating processes of land procurement, most strikingly through the establishment of clean energy parks complete with grid connections. Devleena Ghosh and colleagues have recently written about a particularly notable example of the latter policy. At Pavagda, in the southern state of Karnataka, the years 2015 to 2019 saw the development of one of India's, and the world's, largest solar parks, comprising a cluster of generating facilities under heterogeneous ownership and with a cumulative capacity of around 2 GW spread across some 12,000 acres. Key to making the opportunity bankable for private sector developers, Ghosh and her co-authors explained, was the method of land aggregation employed. The state, in the shape of a joint venture between provincial and central government bodies, did all the work, and shouldered all the expense, of arranging 28-year leases with over 1,400 local landowners, then subleasing this land affordably to the various generating companies that were successful in securing long-term PPAs at auction. 36 For now, at least, the combination of fiscal guarantees to DISCOMs and indirect, land-based subsidies to generators seems to be doing the job. Indeed, as economists from the Reserve Bank of India have pointed out, if renewable power in India today can indeed be generated as cheaply as fossil fuel-based power, it is in significant measure because of the state's latter-day twofold role in the renewables sector as both financial backstop and land agent. 37 v. For all the opprobrium frequently heaped on China in view of its continued substantial investment in fossil fuel-based power, it is unarguable that China, historically and today, has also been the world's leader in driving investment in solar and wind power, in terms both of wind and solar plants generating electricity renewably, and of the turbine and cell technologies used not just by generating plants in China itself, but around the globe. Such, indeed, are the contradictions of the contemporary political ecology of the world's largest nation. At any rate, across the 5 years beginning in 2017, China added more net solar and wind capacity than all of Europe has installed in its entire history. Given the sheer scale and rapidity of this historical investment, and given also the degree of power over economic life that remains vested in Chinese state institutions, it would be naive to imagine that the investment has occurred purely by dint of market forces. It plainly has not. Ever since growth in Chinese solar and wind capacity entered overdrive a little more than a decade ago, it took about 20 years, from the beginning of the 1990s to the beginning of the 2010s, for the share of solar and wind in national electricity output to go from 0 to 1%, but only around another 10 years to go from 1 to 10%. Government support mechanisms have been nothing less than pivotal. The key intervention came with the introduction of feed-in tariffs designed specifically for renewables operators, and initially modeled on Germany's version of this popular policy instrument. FITs for onshore wind were introduced in 2009, and for solar PV in 2011, offshore wind came later, in 2014. Two aspects of China's renewables FITs immediately warrant comment. First, subsidy was explicit, inasmuch as the tariffs received by the wind or solar generator were higher than the tariffs received by fossil fuel-based generating plants. In China, there is a so-called benchmark tariff, established by regulators and varying from region to region, which is that which is paid to coal-fired plants, which still dominate overall generation. We will have more to say about this benchmark tariff, and its importance, in due course. The point to make here is simply that renewables FITs were set higher than this tariff. The increment was to be paid by central government, out of a central fund of renewables energy surcharges on electricity consumption. 38. Second, the expectation and aim from the outset was that the subsidy element incorporated in renewables FITs would be temporary. As investment in the underlying technologies expanded and their costs duly fell, the renewables sector, it was thought, could gradually be weaned off subsidy through progressive reductions of that subsidy. This approach, of course, has not been unique to China. What has been unique to China, however, is the extent of domestic influence over the relevant economic dynamics. It has been principally investment and innovation by Chinese manufacturers that have driven down solar and wind technology costs worldwide in recent times. Since China introduced its renewables FITs, investment has occurred in waves rather than evenly, featuring a series of investment peaks and troughs. These oscillating investment rhythms can be traced in large measure to a series of policy-related factors. One such responsible factor has replicated that which drove a sharp uptick in Spanish renewables investment in the years from 2008 to 2010. As we saw in Chapter 7, Spain, in 2007, introduced FITs that soon turned out to be extremely generous insofar as technology costs fell much faster and further than policymakers had anticipated. Comparable advantageous conditions have been evident in China, in particular in the early 2010s, materializing, that is, in Anders Hov's words, due to declines in wind and solar capital costs that outpaced adjustments to administratively set feed-in tariffs. 39 Essentially, renewables developers exploited an opportunity for arbitrage represented by the growing gap between cost price and tariff price, which was opened up by administrative sluggishness. Something else that we discussed in Chapter 7 was the high levels of curtailment of renewable power that historically have plagued a number of countries, China included. By the mid-2010s, renewables curtailment rates nationwide in China had climbed to above 10%, or rising to multiples of that figure in those regions where renewable capacity was concentrated. Government policy vis-a-vis remuneration for curtailment lacked clarity, but the basic position to that point had been that renewables generators whose production was curtailed were generally not compensated. 40 Clearly, however, high levels of curtailment were a problem for the government's objective of phasing out renewables subsidies. From the perspective of developers, a high probability that a substantial share of output would be curtailed and not remunerated was reason enough not to invest in new capacity. The government reducing or withdrawing subsidies would only compound matters. So the government took action. Most importantly, in 2016, it mandated that renewables generators henceforth must be compensated for curtailment, principally by grid operators, which remain state-owned. Meanwhile, additional measures were introduced to back this principal strategy up. Inspection teams were sent around the country to check that grid operators and local governments were indeed prioritizing renewables integration, and provinces not effectively tackling curtailment were banned from approving new renewables projects, with Gansu, Xinjiang, and Tibet all suffering this ignominy at one point or another. 41. Together, all this worked. By 2019, China had largely solved its curtailment problem, with wind curtailment having fallen to 4% and solar to just 2%. 42 If an initial surge in renewables investment in the early 2010s in response to the introduction of FITs had contributed to causing the elevated curtailment rates of the mid-2010s, then the successful tackling of curtailment from 2016 onwards served, in turn, as a spur, though not the only one, for a noteworthy later investment surge. In 2020, China's net additions of solar and wind capacity more than doubled year on year, to an all-time high of approximately 120 GW. Finally, there has been a third, more readily explicable policy-related driver of swings in renewables investment in China over the past decade or so. This concerns the extent and timing of reductions in the country's central FIT subsidies, which the government eventually felt confident enough to begin to implement. Historical investment data for China, but also for many other countries, show that when deadlines for subsidized renewables investment have been approaching, which is to say when investment must occur by a particular point in time in order to benefit from a rate of subsidy that will subsequently be reduced, money has often poured in order to take advantage while the opportunity lasts. Such last-minute binges represent among the clearest evidence there is of the economic significance that renewables subsidies indeed bear. Unsurprisingly, perturbations of more regular rhythms of investment have tended to be particularly pronounced when policy changes have been substantial and have not been signaled well in advance. Take China's experience with solar as an example. The first half of the 2010s saw a FIT-inspired boom in Chinese solar investment that many commentators expected to last for much longer than it actually did. During the course of 2016, however, the government began making noises to the effect that the bonanza was soon to end, with subsidies to be cut, and perhaps dramatically so. 43 As a result, developers swiftly ramped up capacity investment to avail themselves of the extant subsidies while they still could. In 2017, China, remarkably, accounted for over 55% of global net solar capacity growth. In the event, the government not only did subsequently reduce solar subsidies, but did so in a fashion that sharply limited companies' ability to plan accordingly. In mid-2017, it announced an accelerated attenuation of subsidies, to take immediate effect. 44 No wonder that, having jumped in 2017, the annual amount of newly installed solar capacity then fell back in both 2018 and 2019. Already by 2017, then, the proverbial writing was on the wall for renewables developers in China. The government was indeed determined to phase out explicit subsidies, and it was now beginning the process of doing so. This process was hastened by financial difficulties at the fund that channeled renewable surcharges on electricity consumers into the hands of subsidy recipients. With more renewable capacity having been built than officials had originally expected, and with the same officials having been unwilling to raise the consumer surcharge, the fund had accrued what one observer described as a yawning deficit, leading to payment of the subsidies increasingly often being extremely delayed. This, the same observer said, was a major factor in the eventual closure of the central subsidy program. 45. By 2019, it was clear to all concerned that perhaps 2 or 3 more years of such subsidies was probably the most they could hope for. Thus, while the significant increase in investment in new wind and solar capacity that occurred in 2020, and which was sustained to an impressive extent in 2021, despite a material hit from COVID-19, was spurred in part by the government's successful easing of the country's curtailment problem, it was spurred principally by developers' eagerness to squeeze the final remaining juice out of China's renewables fits. Such eagerness proved justified. In mid-2021, Beijing terminated explicit central government subsidies for newly installed, utility-scale solar and onshore wind. Offshore wind had its subsidy abolished at the beginning of 2022. It is, needless to say, too early to tell what the impact of such subsidy withdrawal will be on the scale and pace of Chinese renewables investment in the medium term. Plenty of observers have worried that investment will now enter a period in the doldrums. But all the evidence suggests that the impact is in fact unlikely to be dramatic. Solar and wind net capacity additions actually reached an all-time high of around 123 GW in 2022. There are several reasons for supposing that investment will remain robust. For one thing, although the central government revenue subsidy has been removed, support in the form of revenue stabilization has not. Companies developing new renewables facilities in China today typically have a choice between selling power into China's embryonic wholesale markets, or taking a 20-year contract that, in place of the specific renewables tariff previously available, pays a fixed price pegged to the regulated provincial benchmark tariff. 46 In most provinces, the IEA remarked in late 2021, utility-scale onshore wind and solar PV projects can achieve reasonable returns with a 20-year fixed price contract at provincial coal prices. As such, the IEA fully expected that most developers would continue to choose this less risky option rather than braving wholesale markets nascent with high price volatility, and that renewables installations in China would remain buoyant despite the termination of the Central Revenue Subsidy Scheme. 47 The aforementioned data for capacity installations in 2022 appeared to bear this optimism out. Then there is the matter of support from the central bank, the People's Bank of China. It is surely significant that just as the government was eliminating its central feed-in tariffs, the PBOC, an arm of the self-same government, was introducing the Carbon Emission Reduction Facility, which, it will be remembered from Chapter 4, helps lower the cost of borrowing for renewables developers. The CERF was launched in November 2021, exactly in time to provide a soft landing for developers newly cut off from central FITs. Whether one calls this a subsidy or not, it quite clearly bolsters the economic viability of new solar and wind projects. Notably, in early 2023, the PBOC announced it would keep the CERF in place until at least the end of 2024. Moreover, the reality is that subsidies per SE, namely of the type that have stimulated China's solar and wind sectors historically, have not disappeared so much as been decentralized. In terminating central subsidies, the government has made it clear that it expects provincial and local authorities to take up the baton instead. To what degree this expectation effectively represents an order is, of course, difficult to tell. One commentator describes the onus that Beijing is now placing on regional state actors vis-a-vis renewables development in terms of active encouragement, others have written simply of increased pressure being applied. 48 At any rate, subsidies do still exist, even if, in view of their devolved nature, they are now considerably harder for external analysts to scrutinize, summarize, and sometimes even see. Monica Sun and colleagues, for example, have noted that local renewables subsidies in China can and do take a range of forms. 49 Notably, is a FIT designed more or less exactly along the same lines as that which was previously offered by the central government, only now granted locally. Such a subsidy is expected to be widely available for offshore wind projects in particular. In April 2022, for instance, the province of Zhejiang, one of the country's most important for offshore wind, announced a subsidy of precisely this type. For projects approved and connected to the grid in 2022 or 2023, the province said it would pay a 10-year subsidy of $0.0042 per kilowatt-hour or $0.0021 per kilowatt-hour above the provincial coal tariff. 50. Other leading offshore wind provinces, interestingly, have opted for one-off subsidies to directly support upfront investment, as opposed to such ongoing revenue subsidies. Guangdong, for example, agreed to meet the cost of $236 per kW of offshore capacity installed in 2022, $157 per kW installed in 2023, and $79 per kW in 2024. Shandong's comparable per kW subsidies were set at $126, $79, and $47 for the same 3 years respectively, and it said that it would pay such subsidies up to maximum cumulative capacity installations of 2 GW in 2022, 3.4 GW in 2023 and 1.6 GW in 2024.51. Given all of this, then, what are we to make of China's zero-subsidy renewables plants, such as the one referred to at the beginning of this chapter, which was the 50 MW Heiyazi wind farm that the China National Nuclear Corporation built at Yumen in Gansu province in 2019. Two observations seem particularly important to make. First, such plants are often not in fact zero-subsidy, still less zero-support, enterprises. The label zero-subsidy typically means zero central subsidy, that is, national feed-in tariff subsidy. What has or has not been subsidized locally, or, since 2021, by the central bank, is another matter, and in any event long-term fixed output prices, often a prerequisite of bankability, remain available. Second, and maybe just as importantly, the phenomenon of zero-subsidy renewables, to the extent that it actually exists, remains strictly at the demonstration or pilot stage of development in China, hence the relatively small scale of all such facilities, Heiyazi included. The central government clearly hopes that zero subsidy proves viable. But the evidence suggests that it is not by any means yet certain that this will indeed be the case. What the Chinese state is doing with subsidy-free renewables is what it almost always does in areas of fast-moving policy evolution, not just in the climate or energy space but more generally, which is to experiment with different policy models locally to see what works, before only then rolling out best practice models nationwide. 52. And, for all the recent shift in renewable subsidies of a conventional form from the center to the provinces, the willingness and staggering ability of Beijing to itself plan and produce major developmental outcomes as it sees fit remains abundantly clear to see. The most noteworthy and significant recent example concerns the gargantuan clean energy bases announced by President Xi Jinping in 2021. To be built mainly in the Gobi and other desert areas, the first batch of these new bases will have a combined capacity of around 100 GW, a second batch, announced the following year, will have a combined capacity of around 450 GW, broadly equivalent to Europe's total solar and wind capacity at the time of this writing. Both batches are scheduled to be completed by 2030. The point to be emphasized here is that these new megaprojects are about as far from being market-led developments as is imaginable. This is not a case of the private sector identifying investment opportunities, weighing profitability prospects and deciding, invest or not. Accordingly, this is the state, in its most centralized and authoritative form, taking the proverbial bull by the horns, and mustering whatever resources it needs at its disposal to ensure that it delivers what it has said it will deliver. Not only does this inevitably mean the involvement principally of state-owned enterprises. More importantly, it means that the very notion of subsidy-free or support-free renewables would, in this instance, be more or less absurd. As one of Blumerneff's experts on the Chinese power sector observed, the GW level bases that will be under construction on massive deserts will require multiple channels of financing and policy support, which China excels at. 53 Nothing if not explicit exercises in central planning. These bases seemingly are, in significant measure, the future of renewables expansion in China. 6. With the termination of the central government's core framework of solar and wind feed-in tariffs and the concomitant shift in support for private renewables development to the provincial level, there is certainly some evidence in China of increased anxiety among private sector renewables developers. Indeed, one well-informed commentator went so far as to suggest, in early 2022, that having played an important role in the growth of renewable energy, the private sector was showing signs of retreating from generation due to policy uncertainty and other barriers to competition. 54. Yet any such retreat in contemporary China is, as yet at least, as nothing compared with what the private sector does when support really is meaningfully removed from a political economic context in which it is patently still needed. For illustrative purposes, let us briefly consider what appears to be the best recent example of that happening. A particularly good question for a future energy market trivia quiz would be the following: which country installed the third most new renewable energy capacity worldwide in 2020? It turns out that the answer is not the US, or India, or one of the leading European nations. In third place that year on the list of renewables investors was a country that only just sneaks inside the world's top 20 on population, and which is outside the top 20 on economic output: Vietnam. In 2020, Vietnam added 11.8 GW of net new renewables capacity, of which 99% was solar. Why so much? The explanation is straightforward. Having introduced a subsidy for solar projects in 2017 in the form of a special feed-in tariff, the Vietnamese government announced that the subsidy would be withdrawn for any projects commencing after the end of 2020. It was this policy deadline, explained the IEA, among others, that precipitated the unprecedented boom in renewable capacity additions in 2020. 55. The following year's investment outcome was equally striking. Solar installations collapsed, literally, to zero, if the data that the International Renewable Energy Agency was able to get its hands on are to be believed. Meanwhile, however, wind installations jumped, from around 140 MW of net new capacity in 2020 to 3.6 GW in 2021. Again, the explanation was the same. Vietnam's wind FITs, introduced in 2018, were slated to expire at the end of October 2021, spurring, in Daniel Kemp's words, a last-minute flurry of development. 56. In 2022, Vietnam's renewables sector found itself saturated with uncertainty. One contributory factor was the fact that a long-trailed pilot program for corporate power purchase agreements, a potential mechanism for giving developers and their financial backers confidence about long-term revenue prospects, continued to be delayed. But the main cause of the uncertainty was clearly the absence of the government's historic explicit subsidies. What principal subsidy or support regime, if any, would follow the FITs? Would it perhaps be auctions, as in most of Europe? Nobody appeared to know. As recently as early 2023, the issue, the IEA reported, had still not been resolved. 57. Unsurprisingly, this uncertain environment proved discomfiting for market actors. Solar and wind developers in Vietnam told the reporter Pei Huayu that they had been left in limbo, unclear about the future of the country's electricity procurement schemes and whether they should even stay in business. What seemed to make especially little sense was that, in the very month, November 2021, in which Vietnam had moved into the post-subsidy era, Prime Minister Pham Minh Chinh had pledged at 26 Colombian pesos to achieve net zero carbon emissions by 2050. All eyes are now on how this pledge to adopt a more extensive use of clean energy will materialize, you wrote in May 2022. 5 years since Hanoi rolled out incentives for solar and wind energy generation, which led to both sources combined contributing about 1/10 of total electricity generation by the end of last year. The industry is now at a standstill. 58. Across 2022 as a whole, net solar and wind capacity additions totaled 2.3 GW, representing a 35% decline on 2021, and the lowest level of installations since 2018. The decline would have been considerably steeper had development finance institutions not stepped into the breach to provide at least some new projects with the bankability that the withdrawal of Vietnam's FITs had summarily eliminated. To take one prominent example, an 88 MW wind farm in Ninh Thuan province developed by BIM Wind was principally facilitated by some $50 million of loans at below market rates from two DFIs and by a $5 million grant from the Climate Innovation and Development Fund. 59. That investment plummets when meaningful support for renewables investment is substantially or wholly removed demonstrates precisely how significant that support in fact is, and also just how marginal, or even downright unappealing, revenue and profitability prospects, in the absence of such support, actually are. Vietnam's recent experience clearly testifies to this, but so also, if in less dramatic ways, does the recent experience of the rest of the world as surveyed in this chapter. 7. Let us make one final brief stopover on our whistle-stop tour of the world of zero-subsidy renewables. We are heading to sub-Saharan Africa, and Zambia. Partly we are heading there because Africa has been notably absent from the chapter thus far, and indeed from much of the book more generally. As we have seen, progress in the development of solar and wind power has been slow there, these two generating sources still accounting for only around 1/20 of overall electricity generation across the continent. Considering African examples is of course important in itself to the building of a balanced picture. But we are also heading to Africa because it turns out the Zambian case we shall consider provides a crucial lesson of much wider significance, namely that the notion of zero-subsidy renewables not only typically is misleading, but can be positively damaging to the very prospects of renewables development. Entering into operation in 2019, the two Zambian solar facilities we are interested in were commissioned in 2016 under the Scaling Solar Initiative launched the previous year by the International Finance Corporation, which is part of the World Bank. The IFC intended scaling solar to facilitate the rapid development of privately owned, utility-scale solar projects in lower-income countries. It would do so, the IFC said, by assisting governments in procuring new solar generating capacity transparently and at the lowest possible cost, including by helping them to organize competitive auctions for the commissioning of such capacity. The target for the initiative was 1 GW of new capacity to be developed by 2019.60. The Zambian plants were the inaugural fruits of scaling solar. Two international developers won bids in 2016 to develop, respectively, a 54 MW and 34 MW plant. They would each sell their output under 25-year fixed-price PPAs signed with ZESCO, the country's state-owned, vertically integrated electricity company, and the only buyer of power from independent producers. In hailing this outcome, protagonists, including the World Bank itself, emphasized two principal features. The first was the strikingly low power prices that Zambia had been able to negotiate, 7.84 cents and 6.02 cents per kilowatt-hour. 61 Gevorg Sargsyan, the bank's then global lead for clean energy, further remarked that, insofar as these prices were fixed for a quarter century, they were actually even lower than they appeared. This, he said of the 6-cent contract, makes the average price in real terms an even more astonishing 4.7 cents per kilowatt-hour. 62 Equally astonishing, secondly, were the circumstances under which this rock-bottom price had evidently been achieved, with Sargsyan, among others, assuring interested observers that there aren't any implicit or explicit subsidies involved in the deal. If the Zambia developments represented an auspicious start for scaling solar, however, subsequent years would profoundly disappoint. Certainly, other developments in other countries did follow, specifically, a 60 MW dual plant facility in Senegal and a 100 MW facility in Uzbekistan, both of which began producing power in 2021, 2 years after the Zambia plants began generating. But that, at the time of this writing in mid-2023, has been all. Representing around only a quarter of the new capacity that the IFC had been targeting for scaling solar by as early as 2019, the cumulative capacity successfully commissioned under the initiative is, as the energy analyst Teal Emery has caustically observed, modestly larger than rooftop solar in the IFC's hometown of Washington, D.C. 63. Zooming in on the region of specific interest to us here, Emery went on to say that despite plentiful equatorial sunshine, falling equipment prices, and massive additions to solar capacity globally, Sub-Saharan Africa continues to lag as a global outlier in solar development. Why is that? Why has scaling solar made barely a dent in the massive stock of latent solar capacity in Africa that could, in principle, be developed? Needless to say, there are numerous contributory factors, but a key one, Emery has convincingly argued, is the fact that the Zambia breakthrough was not in reality subsidy-free. Emery has documented at least 3 different sources of support for the Zambian solar developments that it would be disingenuous to understand as being anything other than subsidies. The first was a subsidy to the cost of the capital that the developers raised to develop the facilities, as in our above-mentioned Vietnamese example. As Emery noted, this subsidy was almost certainly the most financially significant of the 3, while also being the hardest to quantify. Multilateral and bilateral DFIs, including the IFC itself, provided all of the approximately $80 million of debt financing to the Zambia plants, yet they did so at undisclosed rates. How can Emery, and we, be so sure that the actual lending rates were at a discount to market rates? For one thing, the rates offered by institutions of that type invariably are so discounted, that is part of their raison d'etre and operating model. More importantly, and as a Bloomberg NEF analyst concluded in examining the case, the developers simply could not have made the numbers work unless there was significant subsidization of capital costs. Market interest rates would have been prohibitive. 64. Hence Emery's judgment that the debt was likely heavily subsidized. 65. Second, the Zambian government provided infrastructural subsidies of a type that will be familiar to readers from earlier in this chapter. Located to the south of Lusaka, the Zambian capital, the 2 plants were both built on land provided by the government, within an industrial park that already had a reliable grid connection via a substantial local electricity substation. 66. Third and lastly, a study of the Zambian case carried out in 2018 found that, subsequent to the commissioning of the plants, the government also furnished incremental subsidies via tax renegotiations with both developers. 67. And, of course, as we have seen, economic support for renewables projects does not necessarily take the form only of subsidy, and in Zambia the relevant non-subsidy forms of support were several. Most obviously, there were the fixed-price contracts themselves, which provided the promise of revenue stability widely sought by renewables developers and their lenders. On top of that, World Bank bodies provided additional forms of risk mitigation. To offset the perceived risk of signing a long-term offtake agreement with an entity, ZESCO, with a history of well-publicized financial difficulties, the International Development Association, a sister organization to the IFC, provided payment guarantees worth around $6 million. And because the loan financing of the facilities incorporated an element of interest rate risk, the IFC provided rate swaps to mitigate that risk. 68. More valuable still than Emery's documentation of the various forms of support afforded the 2016 Zambian solar developments was his analysis of how the case was presented to the wider world, not least by the World Bank. As we saw, the bank's Gevorg Sargsyan insisted there were no subsidies. Other official messaging, Emery found, then parrot this zero-subsidy narrative. 69. Such concordant messaging included, most notably, a TED Talk praising the inaugural scaling solar project by the former World Bank President Jim Yong Kim, which has been viewed more than 100,000 times. If we want to understand why scaling solar subsequently stalled, Emery has maintained, it is essential to recognize the counterproductive impact of this messaging. The flatly untrue zero-subsidy claim damaged the prospects for further development of the solar market in low-income countries and thus undermined the basic goals of the Scaling Solar Initiative itself because, said Emery, it skewed market expectations and thereby generated misalignments between governments, developers, and lenders. 70. If 6-cent solar can be achieved in sub-Saharan Africa without explicit or implicit subsidies, why, DFIs, for their part, now wondered, should lend scarce concessional dollars to these projects? It was a reasonable question to ask. The World Bank's messaging intimated that subsidized capital was not needed because cheap solar could be developed at market-based financing rates, thus perpetuating what Emery has described as the myth that with some good advice and a little guarantee, small amounts of DFI capital can catalyze large sums of private investment. 71. Meanwhile, the governments of other low-income countries now expected developers to offer bargain basement electricity prices without subsidies being provided to them. This, after all, was what they were told had happened in Zambia. But of course, when not offered subsidies on the same scale as the developers had actually received in Zambia, it proved impossible for developers elsewhere to offer such competitive bids, or at least to do so with any expectation of turning a profit. With developers unable to match Scaling Solar's purportedly unsubsidized low tariff rates, the upshot, unsurprisingly, was disappointment and consternation amongst African governments. 72. Put out not to be receiving the same attractive terms seemingly available in Zambia, some governments even backed out of signed deals. Emery cited Nigeria as an example. In 2016, to accelerate the process of speeding renewables development towards its target of 40% penetration by 2030, the Nigerian government announced it would be awarding a new set of PPAs to solar producers through competitive tender. In the event, contracts were given to 14 producers at a reported tariff of 11.5 cents per kilowatt-hour. But in October 2018, the government reneged. It considered the price too high, and was insisting on a price, 7.5 cents, that the developers rejected. In support of its objection, the government cited competitive solar procurements elsewhere in Africa with prices below 7 cents. Foremost among them was Zambia's. 73. Emery's account of the fate of scaling solar in Africa and beyond is a salutary one. That governments around the world should today laud the alleged economic competitiveness of renewable power is, on the one hand, entirely understandable. It will be recalled from earlier chapters, and will perhaps be recognizable to readers from ongoing daily news reports, that, in many places, opposition to faster renewables deployment remains forceful and fierce. The claim that renewables no longer need economic support can perhaps help quell such opposition, much of which is based on economic arguments, many of these being specious. Yet at the same time, to maintain that renewables are subsidy-free in cases when in fact they are not is to play with fire. It is, if the mixing of metaphors can be excused, to create a rod for the back of the renewables cause. Why won't developers do what we want in the absence of subsidies, governments are liable to ask. Seen in this light, dubious no-subsidy claims are, at the very least, unhelpful, and if they lead to governments digging in heels and thus abandoning or scaling down potential renewables developments, such claims are positively detrimental. 8. How should we sum all this up? Not only, it is evident, has renewables investment worldwide been growing much more slowly than all credible commentators agree that it needs to be doing. And not only, moreover, is demand more specifically for zero-support renewables definitively not booming. But there is in fact a serious question mark as to whether a single example of a substantive and truly zero-support facility even actually exists, anywhere in the world. In other words, despite the remarkable progress that has undoubtedly been made in the past decade in bringing down the costs of solar and wind technologies, The remaining obstacles to generator profitability and attendant investment concerns mean that the renewables sector is still utterly dependent on government support for continuing growth. Or, to express things differently, let us put it this way. If, notwithstanding renewables' relative cheapness, support remains essential, and remains so everywhere, then the inescapable lesson is that however significant an economic impediment to the growth of renewables their cost has been in the past, cost has not been, and today clearly is not, the only such significant impediment. The world in which we currently find ourselves, at any rate, represents a textbook example of what Antonio Gramsci famously called an interregnum, when the old, fossil-fueled power, is dying, though not dead, and the new, clean power, cannot be fully born. That such a scenario is neither one thing nor another, but rather an awkward and dysfunctional hybrid of the two, is, as Gramsci said, the crux of its crisis tendencies. A great variety of morbid symptoms tend to proliferate in this interregnum, Gramsci remarked. It is these morbid symptoms, not electric dreams so much as electric nightmares, that we will look at now. 10. Electric nightmares. In the summer of 2022, much of the Indian subcontinent was roiled by a deepening electricity crisis. The crux of the crisis was insufficient power generation. In parts of Bangladesh, where the government battled to dampen demand through measures such as controls on the use of air conditioning, rolling power blackouts of 5, 9, or even 12 hours a day were reported. It was a similarly bleak picture across India and Pakistan. In the former, schools were forced to close ahead of schedule for the summer break. In the latter, the official working week was cut from 6 days to 5. Everywhere, discontent, dissent and, on occasion, demonstration were fueled by the toxic mix of unstable and deficient electricity supply on the one hand, and, on the other, disruptive state interventions in working and domestic life designed to mitigate the crisis. The proximate causes of the crisis were easy to identify. Most obviously, there was the heat. India, for instance, recorded its warmest weather in over a century, causing peak electricity demand, driven by tens of millions of air conditioning units being switched to full capacity, to surge to all-time highs of above 200 GW. Neither in India, nor in Bangladesh or Pakistan, in the latter of which the situation was exacerbated by severe summer flooding, could generators cope. Partly the problem was a simple shortfall of generating capacity, and, in particular, of capacity located close to where demand was concentrated, and hence not separated from it by strained transmission networks. But more than that, the problem was fuel shortages. All three countries still rely predominantly on fossil fuels to produce power, especially Bangladesh and India, and all three were faced with acute fuel deficits. For those sweltering in the sun, it truly was a nightmare. Not only did blackouts cut off the one source of relief for those households fortunate enough to own air conditioners, but, as Prem Sagar Tasjiankar of the Climate Resilience Group WOTR observed, those power cuts that occurred, as they often did, during evening hours disturbed sleep cycles and left people increasingly fatigued. 1 As resistance to environmental stress was sapped, hospitalizations and deaths from heat stroke soared. Not least among the nightmarish implications were environmental ones, as political commitments to cut emissions paled in the fire of the energy emergency. Insofar as gas supplies were the most pressured, the region engaged in a collective dash for coal. In Bangladesh, for example, the authorities hurried to ready new coal-fired power plants at Payra and Rampal. Pakistan expanded domestic production of lignite, among the dirtiest of coals from a climate pollution perspective. Meanwhile, India doubled down on its own existing coal dependency. In the 6 months from March to September, the country's coal-fired power output was fully 10% or higher than in the equivalent period in 2021. Interestingly, there was only one region of the world where coal-fired power output grew at a faster rate than in India over that time frame. The region in question? The European Union. We will come to Europe in due course. Oddly, though, the best place to begin in attempting to come to grips with what was happening on the Indian subcontinent is somewhere even further away, indeed more or less on the other side of the world. In February 2021, around a year before the emergency situation in South Asia began to develop, the U.S. state of Texas endured its own, albeit considerably shorter, electricity crisis. Untangling the threads of that crisis can help us to frame our understanding of how such crises are both shaped by, and also often reshape in their turn, the political economy of electricity that we have been exploring in this book, that is, a political economy in which the private sector and markets increasingly take pride of place and are expected to do the work of decarbonization that, ultimately, they are ill-equipped to perform. As on the Indian subcontinent, the trigger of the Texas crisis was the weather, though in this case it was cold rather than heat. And whereas in Bangladesh, India, and Pakistan the nub of the problem would be surging demand, in Texas the core problem was constrained supply, while demand, for heating, did surge. The challenge of meeting that increased demand became a crisis principally because the state's generation infrastructure failed it. At one point, almost half the state's generating capacity was offline, literally frozen. Rolling blackouts became, for millions of homes and businesses, outages lasting multiple days, leading directly and indirectly to the loss of life and livelihoods. Initially, in what is a largely politically conservative state, the finger was pointed at its vast network of wind farms. It was these, it was said, that had failed, as turbines lacking the heating kits that come with plants installed in colder climes iced up. For climate naysayers, this was yet more evidence of the folly of excessively hasty decarbonization. But the reality was different. Certainly, many wind farms seized up. But so also, on no less a scale, did plants of other kinds. All types of generation technologies failed, as the authoritative scientific report on the crisis simply put it. 3 Moreover, natural gas failed doubly. Not only did gas-fired electricity plants themselves widely shut down, but gas production, storage, and distribution facilities also failed to provide those generating plants with sufficient fuel. Failures within the natural gas system, in short, exacerbated electricity problems. For so also, notably, did failures within the state's system of forecasting for energy preparedness. The electricity demand projection contained in the most extreme weather scenario modeled by the Electric Reliability Council of Texas, the state's grid operator, turned out to be short by almost 15%. 5. In the official response to the crisis, one feature stood out more than any other. This was the insistence that pricing and markets, the alchemy of supply and demand, should be allowed to do their job. Not only was the crisis not taken to be evidence of the failings of markets, or even a reason to question their role as the preeminent mechanism of coordination of the state's electricity sector, the market was regarded as the very means to manage the crisis. Demand was far higher than available supply, the logic went, so it was only right and proper that wholesale prices rise. They quickly did, from around $50 per MWh to the maximum allowable $9,000. This, reasoned the Public Utility Commission of Texas, was rational and beneficial because it would suitably incentivize the reduction of consumption among price-sensitive, not to mention freezing, users whose retail tariffs followed wholesale rates. As Bill Stetson of the Atlantic Council's Global Energy Center noted at the time, this was hardly a new regulatory standpoint where Texas was concerned. The state, he reminded people, had a history of generator failure during cold weather events, and the primary regulatory response had indeed long been to rely on the market to increase prices during a crisis. 6 So it was once again. In fact, so sacrosanct were the market and the price mechanism that PUCT felt obliged to intervene in the market when it judged that the market had been prevented by ERCOT from operating in an unobstructed fashion. To be precise, it temporarily suspended and overrode market norms, specifically, if paradoxically, to reinforce the market's integrity. The stimulus for this action was ERCOT's imposition of blackouts to maintain system balance across the grid. This, PUCT conceded, was technically necessary, but it was economically undesirable. Why? Because the result of demand being artificially reduced in this manner was a fall in the spot price of electricity from $9,000 to around $1,200 per MWh. One might think that such a fall would have been welcomed, not least given the implied relief for consumers. But one would be wrong for imagining so. The fall was unwelcome because it effectively represented mispricing. An artificial fall in demand had led to an artificial fall in the price. As PUCT explained in the extraordinary letter that it released on February 15, energy prices should reflect scarcity of the supply, and now they did not. Supply was just as scarce relative to actual, underlying demand as it had been before ERCO intervened, but prices had, wrongly, fallen 0.7. As such, it was time for price controls, of a sort. That day, PUCT directed ERCO to modify its pricing models in such a way that the wholesale price would be restored without delay to $9,000 per MWh. Deemed a more accurate reflection of actual scarcity, this is where prices remained, on PUCT's orders, for 5 days. PUCT's specific argumentation for this intervention was incredibly revealing. Partly, of course, this was about price signals being allowed to perform their magic. Insofar as the $1,200 price level was wrong, PUCT said, pricing mechanisms were not generating an optimal response to the challenge. 8. In other words, market actors were not responding to the challenge in an optimal way. Electricity users were not cutting consumption as much as they should, and electricity generators were not boosting production as much as they should, as if a generator being paid $1,200, Stetson witheringly remarked, was insufficient to incent generator performance. 9. In any event, by setting prices to more accurately reflect the scarcity conditions in the market, PUCT figured that responses on both the supply and demand sides would be optimized. 10. But there was a deeper, more fundamental rationale for PUCT's price directive. As well as being erroneous as a measure of the actual relationship between supply and demand, the lower price that cleared after ERCO imposed blackouts was also considered institutionally disruptive, even threatening. Specifically, it contravened convention. When notified, their letter opined, the commissioners agreed that energy prices across the system clearing as low as approximately $1,200 during the first day of the weather crisis was inconsistent with the fundamental design of the market. 11. This was quite the consensus. Seemingly, a very way of ordering economic life was ostensibly at stake. And, so, while Stetson was undoubtedly correct to say that PUCT's intervention demonstrated a fundamental flaw in the over-reliance on markets to provide adequate service to customers, this was not the most important thing the intervention demonstrated. 12. It demonstrated, at its core, a commitment to protecting a particular institutional arrangement, the market as political economic shibboleth. Turning specifically to the fate of renewables operators during the Texas crisis of February 2021, we find certain equally revealing outcomes. To be sure, some wind farms profited handsomely. If they continued to be able to operate more or less as normal, and if they were selling all or most of their output into the spot market, wholesale prices of $9,000 meant vast windfalls for some generators, used as they were to rates of less than $100 per MWh. Yet not all emerged financially in the black. For one thing, even those that were able to continue to generate power did not necessarily benefit from the rocketing of wholesale prices. As we saw in earlier chapters, many of the renewables generators that have sprung up in the US in the past 2 decades, and especially in Texas, have chosen to mitigate the volatility of spot market prices by entering into either financial hedging contracts such as swaps, or bilateral fixed-price power purchase agreements with corporate electricity users. In fact, doing so has generally not been a choice, it has been necessary, to enable the raising of construction finance. For such generators, there were no windfalls to be had, either because they were actually selling at fixed prices, or because financial hedging effectively replicated fixed prices. Moreover, for the owners of some of the many wind farms that were physically compromised by the weather, the financial impact was nothing less than catastrophic. This was because they were legally contracted to deliver a certain amount of power. Unable to generate that power themselves, they were required to purchase the shortfall on the spot market, at what were now, as we have seen, exorbitant rates. This occurred under two different scenarios. One was where the generator held a utility PPA, which, as we saw in Chapter 8, is typically a base load contract, in which the amount of power to be traded is determined in advance. The other was where the generator had entered into a financial hedge incorporating a similar commitment to supply a specified quantum of power at specified dates and times. The latter scenario proved especially ruinous in Texas, the very home of wind hedging. Numerous renewables generators failed to produce enough power to satisfy the terms of their hedges, thus having to turn to the spot market, at $9,000 per MWh, to comply with their delivery obligations. RWE, the German company with wind facilities in the north and west of the state, alone reported a staggering €400 million hit. 13 At least one wind farm owner, in a financial hole to the tune of $71 million for the 10 days during which its turbines iced over, went to court to try to extricate itself from its contractual obligations to the counterparty to its hedging contract, arguing that the storm was an unforeseeable act of God. 14. It was notable who the counterparty was in this particular case: J.P. Morgan Chase, the investment bank. Most counterparties to the financial hedges entered into by U.S. renewables generators are indeed financial institutions, and many enjoyed a very good Texas crisis. Where RWE lost hundreds of millions of dollars, for example, Bank of America gained hundreds of millions. Bank of America takes part in the Texas energy market by trading power and gas and selling products that enable generators and other asset owners to hedge against fluctuating prices, explained the Financial Times. That activity left Bank of America with an inventory of power contracts that surged in value during the blackouts. 15 As so often, mayhem for Main Street translated into windfalls for Wall Street. The irony here is extraordinary, and difficult to miss. More than any other deregulated electricity sector, the US lacks the state-sponsored mechanisms for providing price and revenue stability that renewables generators and their financial backers value so highly, hence the popularity there of corporate PPAs and, going even further back in time, financial hedging. Nowhere has this been more evident than in Texas. Such arrangements constitute market solutions to a problem, price volatility, created by marketization. It was one such market solution, namely financial hedging, that floored renewables generators like RWE, effectively hoist on the petard of the misplaced faith that free markets are an appropriate framework for electricity generation in general and for renewable electricity development and operation in particular. Before we leave Texas, there is one final crucial dimension of the crisis to mention. Why, one might ask, when local electricity generation widely failed, did Texas not simply import power from elsewhere in the U.S.? The simple answer is that by and large it could not, physically. For a whole range of historical reasons, not the least of which has been a desire to limit the extent of federal jurisdiction, Texas's electricity grid is almost entirely isolated, enjoying only limited interconnection to the country's other two main grids. While the exact outcomes would be different, the brief Texas electricity crisis of February 2021, in surfacing this complex but crucial interplay between the respective dynamics of price, profit, power, and place, proved a potent harbinger of what was to come. 2. By early 2021, of course, the world was already 1 year into dealing with COVID-19. Whereas the Texas crisis was precipitated in part by a local surge in energy demand, the pandemic itself was notable for the opposite. As societies and economies went into varying degrees of lockdown, energy demand was widely, though not evenly, suppressed. Globally, primary energy consumption fell by as much as 4% in 2020, the largest fall in decades. If this represented an energy crisis, it was generally not one for electricity generators, still less for renewables generators. More specifically, except perhaps to the extent that lockdowns impinged on the ability of contractors to start, progress or complete new renewable energy developments. No, the COVID-19 energy crisis, such as it was a crisis, or so it appeared, for fossil fuels. As demand for oil and gas plunged, in particular in the transport sector, so also did oil and gas prices. From around $70 per barrel at the beginning of 2020, the oil price had collapsed to less than $30 by March, and it would remain below $50 for the rest of the year. Broken and in survival mode, then, was how The Guardian, for instance, described the state of the global fossil fuel industry in April 2020, as a result of plunging demand for oil wrought by the coronavirus pandemic combined with a savage price war. 16 Citing industry experts, the newspaper said that the industry faced the gravest challenge in its 100-year history and confidently predicted that it would emerge from the crisis permanently altered. If anything, all of this was expected to be a boon for renewables. At oil prices of $30 per barrel, few new hydrocarbon projects would be considered viable, thus ostensibly redoubling the impetus to rapidly develop wind and solar resources. But, as we now know, the COVID-induced suppression of global energy demand, and the fossil fuel industry's putatively grave challenge, turned out to be relatively short-lived. During the course of 2021, overall energy demand bounced back strongly and rapidly, indeed to a level higher than in 2019. And when, and partly because, it did so, what ultimately transpired was a more or less global energy crisis that very much was about electricity, although certainly not only that. While the vast bulk of commentary on the global energy crisis that began in 2021 has focused, somewhat understandably, on Europe, the crisis extended far beyond Europe's borders, as we saw at the outset of this chapter, and, arguably, did not begin there. Michael Davidson, writing in late 2021, made a convincing case that it actually began in a country which very few Western commentators have even considered to be a meaningful part of the crisis phenomenon. 17 That country was China. The crisis in China began around the same time as Texas experienced its own local seizure, which is to say in early 2021. Throughout 2021 and extending into 2022, it took the form, as electricity crises typically do, of an underlying imbalance between supply and demand. On the supply side, the key issue was a secular decline in the ability of China's coal-fired power plants, which continue to dominate domestic power generation, to respond to abrupt changes in demand. This, Davidson explained, was partly because Beijing had cut coal production capacity since 2016 in response to historically low profitability in the mining sector, and partly because of a near-total ban on Australian coal imports imposed in October 2020. On the demand side, the most significant factor was 2021's resurgence in global economic activity as countries, though not, ironically, China itself, or at least not its non-factory workers, emerged from lockdown. In light of China's role as the 21st century's workshop to the world, the uptick in global activity from the beginning of 2021 created soaring demand for electricity in China's coastal provinces, which are home to many of the country's largest factories. In May 2021, various cities in Guangdong implemented industrial power rationing. By September, power restrictions had already spread to more than 20 provinces, as unseasonal weather, cold in the north, warm in the south, inflated electricity demand further and pushed grids to the brink. Shortages were especially severe in the northeast, where whole communities endured rolling blackouts. 18. In a number of important respects, China's experience foreshadowed much of what we would see in the emerging energy crisis elsewhere in the world. One was the particular significance of interactions between fuel markets and electricity markets in the shaping of the crisis. In Europe, as we shall see, the fuel in question would mainly be natural gas, but in China it was coal. It was difficult for China's coal plants to respond to surging electricity demand not only in simple physical terms, but also economically. On the one hand, Such plants faced rapidly rising coal prices, resulting from the aforementioned supply shortages. But crucially, they were substantially unable to pass these increased costs on to electricity distribution companies and ultimately consumers because they were required to sell their output at regulated provincial tariffs that had been formally delinked from coal prices in 2019.19. Beijing's decision to permit plant sale prices to depart modestly from these benchmark rates helped somewhat, but only somewhat. Essentially, as Yan Qin observed, coal-fired plants found themselves squeezed between market coal prices and regulated electricity prices. 20. This squeeze persisted into 2022, and intensified in the summer months, when the central and eastern parts of the country suffered the most serious heat wave in decades, renewing upwards pressure on both electricity demand and the price of thermal coal. Reporting in late 2022, China's electricity regulator said that the power supply situation in the aforementioned parts of the country was severe and that across the first 9 months of the year, the fuel costs of China's coal-fired plants were around $40 billion higher than 2021's already inflated levels. 21. Another important way in which China foreshadowed subsequent experiences elsewhere in the world was in how the profit motive, and generators' understandable compulsion to prioritize it, tended to worsen matters. One research organization estimated that, in September 2021, on account of the dynamics identified in the previous paragraphs, Chinese coal-fired plants were on average operating at a loss of around 2 cents per kilowatt-hour of output. 22. Indeed, the authorities themselves later conceded that making a loss had become more or less endemic in the sector. As of October 2022, more than half of the country's state-owned coal power companies, by Beijing's own admission, remained in the red. 23. Unsurprisingly, many generators, and especially those in the private sector, were highly reluctant to continue to generate if doing so meant continuing to incur losses. The rational response in this situation was not to ramp generation up, as grids and users urgently required given rampant demand, but down. Which, to avoid generating at a loss, is what many plants did, specifically by drawing down inventories or faking outages. 24. Perhaps it was indeed the self-interest of the butcher, brewer, and baker that kept people fed in Adam Smith's 18th-century Scotland, but the self-interest of the coal-fired power generator did not serve to keep lights on in China in 2021-2. Australia, interestingly, being part of the same broad regional trade bloc, experienced in mid-2022 a similar squeeze, eliciting a similar response from its conventional power plants. High demand for power generation combined with shortages of both coal and gas to produce rising fuel prices and, Australia's electricity market being based, like Europe's, on the merit order, rising wholesale and retail power prices. The response of the regulator, AEMO, was to cap the spot market power price, which in some states had been allowed to rise to above $15,000 per MWh, at just $300. Naturally, given fuel prices, many conventional generators, as in China, were faced with huge losses if they continued to generate. So they did not continue to generate. The amount of generating capacity online collapsed and AEMO was forced to suspend wholesale trading. Briefly, Australia had an electricity sector with no recognized transaction mechanism, a market without a market, as one observer put it. 25. Meanwhile, where China not only gave a strong foretaste of subsequent developments elsewhere, but also closely replicated developments in Texas, was in the striking hegemony of market ideology among sundry leading experts. The consensus among such experts was that China was enduring an energy crisis not because of the marketization that had been undertaken over the previous decade or so, but because the country's embrace of energy marketization had been half-hearted, partial, and incomplete. The invisible hand was still unduly fettered, in short. Thus the answer, including, notably, to the still burning question of how best to hasten decarbonization, was not backtracking, but, instead, further market-led reforms. It takes effective market mechanisms to ensure that each power-generating and related technology, in particular clean technologies, is compensated sufficiently to operate and invest in a sustainable manner, argued Lara Dong. I wouldn't call it a failure of the electricity market. Dong's own, entirely representative, assessment of the turmoil in China's energy sector in 2021 therefore ran, but rather say that China has not yet been able to set up a functional power market. 26. Of course, for evidence of the dangers of Dong's supposition, one needed only to look at what was concurrently happening in the region of the world that has long been the very poster child for electricity in its most marketized imaginable form, namely Europe. 3. It started later in the year, but when energy crisis hit Europe in 2021 it bore considerable resemblance to the crisis that was already in full bloom in China. 4. More than anything else, the crisis was rooted in a surge in energy demand for which the relevant infrastructure and institutions were not prepared. In Europe, that post-COVID surge came in the autumn. And much like in China, part of the reason why Europe's electricity system failed to respond as hoped was that it could not lay its hands quickly enough and cheaply enough on sufficient fuels to fire its power plants. There were, however, three major differences between what transpired in Europe and what had been going on for months already in China. They are crucial to understand. First, it was a different pivotal fuel that was suddenly in short supply. Whereas China scrambled for coal, Europe was now scrambling for natural gas. Gas was the single largest source of electricity generation in Europe, accounting for around a quarter of all output in 2020, the year before the crisis developed, and, crucially, the cold winter of 2020-1 had left stocks relatively depleted. In autumn 2021, these stocks could not be replenished fast enough. Second, gas shortages had a material impact on the finances of electricity retailers and consumers in Europe in a way that coal shortages did not in China. In the latter, as we have seen, electricity tariffs are heavily regulated. In 2021, Chinese coal-fired plants were largely unable to pass on increases in fuel costs. Indeed, that was part of the problem, at least for generators. In Europe, however, increased natural gas costs in autumn 2021, a result of the sudden paucity of supply relative to surging demand, could be, and were, passed on to electricity retailers and consumers. Indeed, for reasons we established earlier in this book, wholesale and retail electricity prices in Europe are in fact disproportionately influenced by gas prices. The proportion of the time when gas provides the all-important market clearing and price-setting last unit of supply in Europe's merit order-based electricity sector substantially outstrips the proportion of electricity that gas actually physically serves to help generate. Thus, if Europe's gas prices increase, so, in turn, do its electricity prices, not for every hour, every day, since there will be periods when gas plants are not required to fire and thus when other sources will set the spot price, and not in the same degree in every country, since some countries are more reliant on gas for electricity generation than others, but, averaged out, the relationship holds. And that is exactly what happened in Europe in late 2021. As gas prices climbed, the prices paid by electricity retailers and users also climbed. Notably, in Europe, the combination of rising natural gas prices with dispatch based on merit order had deleterious, indeed morbid, environmental implications as well as deleterious economic ones. By 2020, coal had seemed destined for the scrap heap of history as a major source of European electricity. Its LCOE had been progressively deteriorating relative to renewables and gas, meaning it had increasingly dropped out of merit. Between 2012 and 2020, the share of Europe's electricity generated using coal declined every year, nearly halving from 24.4% in the former year to 12.8% in the latter. But as gas prices spiked in 2021, coal, in many European countries, was suddenly back in merit. Coal-fired generation in Europe leapt by more than 10% in 2021, therefore 0.27. Third and finally, if, in Europe, the evolving energy crisis in 2021 had an impact on the costs incurred by electricity users more than in China, there was much less of an impact in terms of service. As we saw earlier, China experienced relatively widespread rationing and blackouts. Europe did not. In fact, not only did service continue broadly as usual across the continent, but in 2021, at any rate, even the possibility of rationing, still less blackouts, was barely whispered. This would change, however, in 2022. If Europe was definitively experiencing an electricity crisis of sorts by the winter of 2021, the crisis deepened, and took on an entirely new hue, in February 2022, when Vladimir Putin's Russia invaded Ukraine. When the rest of Europe threw its support behind Ukraine and behind a battery of international sanctions aimed at kneecapping the Russian economy, Putin responded with the only meaningful geo-economic weapon at his disposal, energy. Much of the imported coal, oil, and gas upon which Europe in around 2021 was heavily reliant was imported from Russia. During the course of 2022, Putin therefore increasingly cut off those supplies, presumably in an attempt to drain Europe's enthusiasm for support for Ukraine. Where gas specifically was concerned, Europe's imports from Russia fell by more than half year-on-year in 2022.28. Needless to say, the effect was to intensify the principal dynamics familiar from late 2021. Thus gas prices soared ever higher as Europe, already experiencing significant supply constraints, was increasingly required to turn elsewhere than Russia for its imports, and electricity prices continued to follow gas prices vertiginously upwards. By late summer, with Putin turning the screw ever tighter, a perfect storm appeared to be approaching, as the continent's hydro and nuclear generating capacity also wobbled. The Economist glossed the evolving European electricity nightmare thus. In recent weeks, forward prices for daytime electricity for the fourth quarter of the year briefly spiked above €1,200 per megawatt-hour in Germany and above a surreal €2,500 in France. The usual price is around €50. The reason for this is simple: scarcity. The loss of generating capacity to maintenance, closure, and drought brought more and more gas plants into action, and their fuel has become extremely expensive since Russia wielded its energy weapon. 29. Sky-high prices were one thing. Indeed, across 2022 as a whole, European gas prices were more than 5 times higher than their 2016-21 average, and the demand-weighted average wholesale electricity price for France, Germany, Spain, and the UK in the second half of the year was almost 4 times as high as the 2019-21 average for those 6 months. 30. But now, as the summer of 2022 turned to autumn, rationing and even blackouts seemingly also loomed. Experts prognosticated about which European countries and regions were the most likely to face winter power cuts. 4. What did Europe's policymakers do in the face of this crunch? Their main priority on the electricity front was to shield users, to a certain extent, from rising costs. They did this in an assortment of different ways, comprising various combinations in different countries of tax deductions, price controls, and transfers to vulnerable groups. 31 The overall tapestry of interventions was, and indeed remains, highly complex and constantly evolving. The details need not detain us, but, in the context of the key themes of this book, 5 brief points about these measures are particularly important to highlight. First, policies were discussed and enacted at a range of different geopolitical scales. Some were EU policies, which individual countries were expected, albeit with a certain degree of freedom, then to implement at the national level, and to which they were required to adapt their own chosen national measures. Alongside these transnational and national policies, some of the bigger European countries also featured significant subnational interventions. Second, policymakers attempted to varying degrees to avoid generating moral hazard. The worry was that, if electricity users were fully shielded from the risk of high energy prices, they would have no incentive to reduce their exposure to that risk. In short, the policy objective, easily articulated, fiendishly difficult to realize in practice, was to protect users from savage cost increases without further fueling consumption, and thus making the underlying imbalance between supply and demand even worse. One way in which policymakers sought to do this, at least in some countries, such as Germany, was by introducing measures to curb electricity demand, alongside measures relating to the cost of its supply. Third, this wariness of moral hazard was part and parcel of a deeper, long-standing commitment to the sanctity of markets and price signals. The fundamental concern with measures such as price controls, from this standpoint, was that they would interfere with markets, muffle price signals and, as in the case of ERCOT and Texas discussed earlier, prevent actors from responding optimally. The International Monetary Fund was just one of the bastions of market orthodoxy to encourage EU policymakers to keep the faith, permit markets to continue to function normally and thus pass the full increase in costs on to users. 32. No European government did this, in reality, but some would brazenly claim to have in fact remained strictly true to market discipline. Germany's finance minister Christian Lindner was perhaps the most brazen of all, describing his government's electricity price brake, which literally and overtly reduced the price paid by consumers, as an instrument that functioned without any intervention in markets or prices. In contrast to instruments used in other countries, Lindner crowed, our new arrangements will not affect the price formation process driven by supply and demand. 33. Fourth, we should nonetheless remember, from Chapter 2, that, for all the talk of normal market functioning, the European electricity sector never actually had been quite the unblemished market mecca that, during the crisis, many, on both left and right, imagined that it had. Even before the beginning of the energy crisis in Europe, the state was actively involved in intervention in price setting for household electricity customers in more than half of EU countries. The point, to which we shall return in Chapter 11, is that the closer one looks at electricity profits and markets, even in the most normal of times, the more chimerical, and less free, they appear. Finally, and most importantly of all from our perspective, the support that European governments did elect to provide to electricity users during the crisis that began in 2021 and intensified in 2022 was to be funded partly by taxes on suspected windfall profits at generating firms. Insofar as the main motor of the upwards pressure on wholesale electricity prices was rising gas prices and their channeling into power prices through Europe's merit order electricity pricing model, generators of some types, it was widely concluded, must now have been swimming in profits, not least the operators of solar and wind farms, which therefore found themselves directly in the crosshairs of European policymakers looking both to fund user subsidies and to crack down on perceived profiteering. The logic underlying the conviction that renewables firms operating in Europe were now enjoying inflated levels of profitability is not difficult to grasp, and indeed makes perfect intuitive sense. 34 Wholesale prices had increased substantially. But, for renewables firms, unlike for gas-fired plants, which were now contending with soaring gas prices, operating costs had not similarly increased. Such costs, as we have seen, are minimal, and do not comprise fuel costs. It was, or rather seemed, as simple as that. Quod erat demonstrandum, costs flat, revenues up, profits also up. The flaw in this logic, of course, is that even in Europe, with its deep and wide electricity spot markets, not all renewables power output is actually valorized at spot market prices. Some such output circumvents the spot market altogether and is commonly sold at fixed prices, either via government feed-in tariffs or under long-term bilateral commercial contracts. And much of that which is in fact sold in the spot market is not monetized by the generator at the spot price because the generator has hedged its exposure to price volatility either through the use of market-based financial instruments like forward contracts or, more often, through government mechanisms of revenue stabilization such as feed-in premiums. So, when policymakers across Europe, initially convinced by the aforementioned straightforward logic, began drawing up plans for windfall taxes on generators, they quickly discovered the issue to involve enormous conceptual and informational headaches. As The Economist abruptly pointed out, only some renewables capacity was really racket in. 35 In fact, some facilities, having hedged too aggressively, were now, almost perversely, losing money, among them French and German wind and solar farms owned by Norway's Statkraft. 36. Warming to its theme, The Economist made the important additional observation that because many of the contracts that determine generators' ultimate revenues are private and confidential, even just identifying winners and losers, never mind taxing the former, would be challenging, and perhaps even impossible. The true recipients of the windfall profits, it warned governments, may prove hard to find. Moreover, as had been the case with Texas and Bank of America, such recipients, The Economist further cautioned, may in fact sit outside the energy market. 37. Flummoxed by the complexity, some European countries briefly shelved their plans to impose such windfall taxes. Having announced in May 2022 that he would introduce such a tax, for example, Rishi Sunak, then the UK Chancellor, indicated just a month later that he had cooled on the idea, his officials signaling that it was proving to be too complicated to instigate. 38 Others, however, pushed ahead, Germany among them. Country-specific taxes within the EU, such as Germany's, were to some extent superseded in September 2022 when the bloc's energy ministers agreed an EU-wide windfall tax on non-gas power producers, taking the form of a revenue cap set at a maximum of €180 per MWh. 39 To apply in the period from December 1, 2022 to June 30, 2023, revenues earned above that threshold were to be redistributed to electricity users. Notably, upon announcing the tax, the EU's ministers highlighted what to them was a pivotal feature of the tax's design. It was one with which we are, by now, very familiar. A primary consideration, it was explained, had been to avoid distorting the wholesale electricity market. 40 The market is dead, long live the market. Meanwhile, the UK, now with a new chancellor at the helm, soon followed suit. Its own windfall levy was different, a temporary 45% tax on the extraordinary profits of renewables and nuclear generators, namely those made on electricity sold above £75 per MWh, but it had the same premises and purpose. Shortly after the UK's version of the tax was announced, the research firm Bloomberg NEF reported the results of its preliminary analysis of the policy. Perhaps the most interesting part of the analysis concerned its estimate for how much of the UK's renewables capacity would potentially be subject to the tax, given the extent of utilization of the types of direct and indirect mechanisms of price stabilization mentioned above. Bloomberg NEF reckoned that, in the event, only a minority share of such capacity would actually be liable. More than half of UK onshore wind, almost half of offshore wind and almost all solar would likely be exempt. 41. For observers of the political economy of energy, the crisis that engulfed Europe beginning in 2021, and governments' various attempts to respond to that crisis, summoned all manner of different powerful images, price charts exhibiting exponential growth rates, diagrammatic explanations of the hitherto mysterious but suddenly all-important merit order, and so forth. But none, maybe, would be more abiding, or more important to thinking about our energy futures, than the image of themselves that policymakers collectively, if unwittingly, presented to the world. This revealed, in short, an institutional community that, in its efforts of the past 3 decades first to liberalize, and then to decarbonize, the continent's power sector, has fashioned a creature whose complex and contradictory nature they barely even understand, let alone can begin effectively to manage. This image was never clearer than during all the confused political deductions, deliberations, and decision-making with regard to power sector windfall taxes. When the winter of 2022-3 finally arrived in Europe, commentators increasingly began to notice and discuss an interesting phenomenon. For all the widely voiced fears about absolute energy shortages, electricity blackouts, and crippling knock-on effects on households and industry alike, the Federation of German Industries had predicted a massive recession. For instance, the reality, it appeared, was that none of this was in fact coming to pass. Two comment pieces in the Financial Times, by two of the newspaper's highest-profile writers, captured the shifting mood. The end of Europe's energy crisis is in sight, enthused Chris Giles, as early as October 2022. 422 months later, noting that there had been zero impact on output levels in European manufacturing. Martin Sandbu was even minded to ask, what energy crisis? 43 writing in the same newspaper, the German finance minister, Christian Lindner, whose spurious claims about his country subsidizing power consumption without distorting price signals we encountered earlier, argued something similar in the first week of 2023. Horror scenarios of a dangerous energy rationing or a massive slump in our economy have often been bandied about, Lindner wrote. But we are nowhere near that. 44. For our purposes, commentaries such as these are important less for the degree of accuracy with which they represented the actual extent of crisis, than for how they chose to explain Europe's apparent robustness in the face of its manifold energy challenges. And, on this point, Giles, Sandbu and, indeed, Lindner were evidently in full agreement with one another. What had saved Europe, they argued, was the market. More exactly, Europe had, the argument ran, remained committed enough to market processes to enable the price mechanism to promote relatively optimal responses. Thus, when the price of gas surged, by this argument, both the intermediate consumption of gas for electricity generation, and the final consumption of gas by households and businesses, declined, partly through switching to cheaper substitutes, precisely as, in a landscape of rational economic actors, they would be expected to do. All three writers, then, interpreted Europe's non-energy crisis as a story of the triumph of the market, specifically in the sense of successful behavioral adaptation. As Giles, for instance, cheerily put it, the price signal has done its job. It has forced Europe to adapt. Advanced capitalist economies, he went on, as if to drive his point home, are remarkably successful in this regard. 45 Lindner made the same case, but with a focus just on his homeland. German industry and society, he proudly proclaimed, are once again proving much more resilient and adaptable than certain people feared. 46. What are we to make of these assertions? The appalling, unmentioned environmental implications of Europe's successful adaptation are certainly one thing to reckon with. Adapting entailed another significant annual increase in coal-fired power generation, coming on the back of 2021's own disastrous such increase. 47 This increase was the main explanation for 2022 seeing the highest growth in CO2 emissions from EU power generation for half a century. The CO2 intensity of all source generation rose by 7%. 48. Among the notable national contributors to this increase was Spain, which, alongside Portugal, received an exemption from the European Commission allowing it to cap the price of coal and gas used by its electricity generators, leading to an annual increase in its coal-fired power generation of around 50%, albeit from a low base. 49 But, in absolute terms, the biggest contributor to 2022's increase in coal-fired generation in Europe was, ironically, Lindner's resilient and adaptable Germany, where, for the second year running, such generation increased by more than 10%. 50. Leaving aside the environmental impact, however, the narrative rehearsed by Giles, Sandbu, and Lindner was wrong-headed and misleading even as a reading of how Europe managed to avoid greater turmoil among energy users. Certainly, some actors adapted in 2022 to changed price signals, at least somewhat. But, in reality, despite gas prices reaching all-time highs, the intermediate consumption of gas, that is, its use for electricity generation, in the EU actually increased year-on-year, by 2%. 51 At the same time, adaptation to sky-high electricity prices took the form of an annual reduction of power consumption of only 3.5% EU-wide, even with the considerable benefit of one of the warmest winters on record. 52. More importantly, the role of the adaptation lauded by those writing in the Financial Times in steering Europe through choppy waters and keeping lights on across the continent was trivial in relative terms. To read Europe's fortune in avoiding the traumas of, say, China or Texas as evidence of the wonders of price signals in nudging market actors to adapt is to ignore the role of other, considerably more consequential, forces. To wit, what has been narrated as a parable about the productive powers of markets is in fact principally a story about two other things. The first is government support. Europe's households and industry came through the energy crisis relatively unscathed thanks mainly to the fact that European governments came to their aid. Marshalling their unrivaled financial wherewithal, rich country governments, in particular, supported homes and firms on a prodigious scale. Researchers for the economic policy think tank Bruegel calculated that, between September 2021 and the end of 2022, European governments stumped up not far short of €1 trillion to protect residents from rising energy costs. 53 The beneficial effect of any behavioral adaptation in response to price signals was utterly dwarfed by the cushioning effect of this largesse. Which government was the most lavish in its support? In irony of ironies, it was Christian Lindner's ostensibly non-market distorting German government. In terms of both absolute expenditure and the proportion of gross domestic product that expenditure represented, the German state's largesse outstripped that of all its European peers. 54. The second thing that enabled Europe to ride out the energy storm much more than did price-motivated behavioral adaptation was a strategic shift in gas procurement, and here we come to an altogether less laudatory aspect of market mechanisms, but arguably their nub. To survive the crunch precipitated by Putin's invasion of Ukraine in 2022, Europe, in reality, did not cut back on gas consumption so much as change where it is imported from. That is, to compensate for the huge decline in imports from Russia mentioned above, it rapidly ramped up imports of natural gas from other world regions. This was, by a huge margin, the most important measure in enabling Europe to maintain its electricity generation capabilities in a functional state. In 2021, European imports of natural gas from regions other than Russia totaled 220 billion cubic meters. In 2022, they leapt to 292 billion. 55. European nations pulled this trick off because they could. In other words, they could afford it. The fact is, however, that the gas supplies that Europe successfully hoovered up from elsewhere in the world were ones on which other, poorer world regions, now priced out, were themselves substantially relying in order not to be pitched into their very own gas and electricity nightmare. And what facilitated this trick was, of course, the market. Europe got its supplies because it had money, or, at least, more of it than other places, and money, in markets, talks. Who lost out? More than anywhere else, the Indian subcontinent did, and hence we are back to where we started at the beginning of this chapter. As we saw, when the electricity sectors of Bangladesh, India, and Pakistan widely stuttered in the summer of 2022, the crux of the problem was insufficient fuel to fire power plants challenged by unprecedented weather-driven demand. Gas was the fuel in shortest supply, and Europe's new import strategy, it turned out, played an increasingly significant role in exacerbating the shortages in question. All three countries, together with Sri Lanka, saw imports dry up as trade was effectively diverted to wealthier, European-based customers. The European gas crisis is sucking the world dry of liquid natural gas, Valerie Chow of the energy research firm Wood Mackenzie observed in July 2022. Emerging markets in Asia have borne the brunt of this and there is no end in sight. 56. Alongside Bangladesh, Pakistan was seemingly the worst affected. In 2017, Pakistan had handed long-term contracts for the supply of gas to Italy's ENISPA and the Cypriot domiciled trading house Gunvor Group. In 2021-2, however, as gas prices in Europe, and in turn globally, climbed, both of these suppliers cancelled numerous shipments to Pakistan while continuing to supply within Europe. Industry insiders told Bloomberg reporters Steven Stapczynski and Facey Mangy they couldn't remember the last time so many cargoes were scrapped without being directly related to a major outage at an export facility. 57. There was, seemingly, a brutally rational economic logic to this. Whereas energy contracts with Western customers typically incorporate failure to deliver penalties of up to 100%, or recall the owners of frozen Texan wind farms being required to buy power at sky-high prices on the spot market to meet the delivery terms of hedges, Pakistan's contracts evidently contained a cancellation penalty of only 30%, or most likely, Stapczynski and Mangy conjectured, in exchange for lower prices. The reporters estimated that in the summer of 2022, the price at which natural gas could be sold in Europe was more than 150% or higher than the price stipulated in Pakistan's contracts with ENI and Gunvor. 58. A 30% or penalty for cancellation would presumably have seemed a price very much worth paying for such a premium. In any event, Ananya Bhattacharya spoke for many when, months later, she raged at Pakistan's market impotence relative to richer countries that are able to pay higher prices. All this, she reminded readers, while millions of citizens continue to live without electricity for more than 12 hours a day. 59. At one point, as much as around a quarter of Pakistan's operational power generation capacity of 28 GW was shuttered, due principally to fuel shortages, and with most of the forced outages occurring at gas-fired plants. 60. If, then, as both the German finance minister Christian Lindner and the Financial Times's Chris Giles insisted, energy markets and price signals indeed saved the day during the 2021-2 crisis, then they did so only, but also by their very nature, for those countries that happen to be relatively rich in the particular currency that serves as the medium of exchange in such markets, which is, of course, money. It was ever thus. Europe's answer to the gas crisis that Vladimir Putin dramatically escalated in early 2022 was, in large measure, effectively to export that crisis to the Indian subcontinent. That it did so indirectly and, one imagines, unwittingly does not diminish the fact that it happened. Thus Martin Sandview's rhetorical "what energy crisis?" was the conceit of someone who only failed to see crisis because it had been successfully displaced elsewhere. While it is capitalist markets that facilitate such displacements, it is the fetishism that haunts market capitalism that perennially makes it difficult for us to see the displacements in question. Sandview, after all, was scarcely alone. Markets are the supreme vehicles of desocialization. What we see being traded in markets is a thing, a trinket, a laptop, liquid natural gas. We systematically refee this thingness, thereby treating it, rather than the social and geographical worlds in which it is embedded, as what really matters. 6. What, meanwhile, did Europe's electricity crisis, such as it was, mean for renewables, beyond the windfall taxes levied on solar and wind generators? Data suggest that the crisis provided something of a fillip to the sector. Europe, as a whole, added 56 GW of net new solar and wind capacity in 2022, which represented a gain of around a third on net capacity growth achieved in 2021. The counterfactual, how much, all other things being equal, would have been added in 2022 were it not for the crisis? Is, of course, something that can only be guessed at. What is nonetheless clear is that this was both the strongest growth in years, and considerably stronger than forecasters had expected. It is, to be sure, possible that the crisis was not, in fact, a significant boon for the renewables sector, and that growth would have been strong regardless, but it definitely was not a bust. We know that much. Predictably, commentators were quick to thank markets and the hallowed signals contained in market prices for the apparent hastening of the shift into renewables. This was the main line taken, for example, by the IEA, when, in late 2022, it revised its renewables projections upwards in the light of recent developments. As gas was becoming more expensive as a source of energy generation, so the IEA's argument went, The cheaper sources to which European countries were increasingly turning included not just dirty coal but also, in terms of new capacity investment, clean renewables. Chris Giles at the Financial Times said much the same. So did Adam Tooze. This investment is happening, Tooze confidently asserted, because solar and wind offer power at unbeatably low cost. 61. Again, however, it is far from clear that the uptick in renewables investment in Europe in 2022 actually had much at all to do with price. If one paid attention to the statements of the various European policymakers who, in 2022, urged and facilitated expanded investment in renewables capacity, one discovered that something else was powerfully motivating them. That something was concerns around energy security. If 2022 taught European policymakers anything, it was that relying on foreign nations for energy provision was a greater risk than had widely been presumed. The more a country can generate its own power, the lesson seemed to be, the better. And one of the ways in which renewables plants are unique, of course, is that, unlike nuclear or fossil fuel-fired plants, they are self-sufficient once built. There is no fuel, and hence no potential dependency on unpredictable fuel suppliers. In the past, the big driver for renewables was decarbonization. Adrian Zoko, Executive Director for Clean Energy Technology at the financial analysis firm S&P Global, remarked in early 2023. What has changed since 2022 is that energy security has also become a big driver of policy for renewables, especially solar. 62. Thus when, for example, in November 2022, Prime Minister Rishi Sunak pledged to accelerate the UK's switch to renewable energy, he did so explicitly on the ground of energy security and environmental benefits, not cost benefits. Energy security, similarly, explicitly inspired renewed vigor in renewables investment in 2022 in countries ranging from Greece to Denmark, and from Switzerland to the Baltics. More than anywhere else, perhaps, it was Germany that epitomized this overt political insistence on a newly augmented synergy between renewables investment and energy security. 63 Its reliance on Russian coal and gas, now perceived as reckless and misguided, had got Germany into the predicament in which it found itself in 2022 as energy ties with Putin were severed. Doubling down on renewables, whose capacity growth had in fact markedly slowed in Germany since around 2018, was now posited as the way out of that predicament. If the new spring in renewables step in Europe in 2022 was not principally about price, neither, it should be emphasized, was it about profit. From the perspective of renewables developers and the banks that lend to them, Europe had not suddenly become a significantly improved investment proposition. Certainly, wholesale electricity prices had increased dramatically, meaning that wind and solar farms selling predominantly at merchant rates could expect to generate much higher revenues if those higher prices persisted. But, as we have seen, many generators did not and do not sell predominantly at merchant rates. Furthermore, if wholesale electricity prices had increased, so too, of course, had raw material, construction, and financing costs. No less importantly, the question that developers contemplating new investments had to reckon with was, for how long would spot market rates remain inflated? Would they come back down to earth once Europe had fashioned and adjusted to a new, post-Ukraine gas supply regime? Nobody with any substantive experience of Europe's capricious energy markets, least of all risk-averse debt financiers, would have been willing to wager that inflated electricity prices represented some sort of new European norm, and thus would remain in place after the several years needed to plan, develop, finance and build new generating facilities. Moreover, whatever their absolute level, wholesale electricity prices in Europe remained as volatile as they had ever been. Of particular significance to the all-important yardstick of expected profitability were the windfall taxes on low-carbon electricity generators that European governments introduced in 2022. The risk that governments always face in imposing such levies is that of disincentivizing future investment. It will be remembered, for example, from Chapter 7 that this was exactly the outcome of Spain's effective windfall tax on excess renewables profits in the early 2010s, money withdrew en masse from the market. European legislators were very much alive to this risk in 2022, and they made it clear that, in crafting their windfall taxes, they were determined to protect underlying profitability, not to jeopardize and compromise the profitability of existing plants and future investments were the EU's exact words, as well as market integrity. 64 But, for all that policymakers remained alert to the dangers of exerting a chilling effect on future investment, and though they designed their taxes accordingly, they could not wholly mitigate that risk. Sure enough, within months of the taxes being announced, renewables developers were warning about project cancellations. Calling the UK's levy unfairly disproportionate, discriminatory, and adverse to the government's net zero strategy, one such developer even threatened the UK government with legal action unless it amended the tax. 65. Furthermore, as Bloomernef's Nathaniel Bullard, among others, pointed out, windfall taxes not only suppress profits in the short term but exacerbate uncertainty around profit expectations in the longer term. Even if projects remain profitable, Bullard observed, the tax injects uncertainty that could impede further renewable development. 66 When, and how, might the state cap revenues or profits next time? Developers surveying the European renewables landscape in around 2022 could not but ask themselves this question. Indeed, some did so very publicly, Ignacio Galán, executive chair of Spain's Iberdrola, asking, equal parts rhetorically and indignantly, in an interview with the Financial Times conducted shortly after the EU announced its €180 revenue cap, if you intervene at €180. And why not tomorrow €120? 67. Bullard made another important observation in this regard. He reminded his readers that many renewables developers operate internationally and inevitably weigh investment opportunities in different countries against one another. Thus he proceeded to compare the renewables windfall taxes introduced in the EU and in the UK with one another, and to ponder which might be the more likely to deter future investment, and which territory, seen from the other side, might henceforth be the more attractive investment option. But the more relevant comparison actually would have been between Europe and the US. That any boost to the European renewables sector associated with the energy crisis of 2021-2 was definitively not about enhanced profitability prospects in the region was confirmed by developers' own statements concerning the relative attractiveness of investment opportunities on either side of the Atlantic. A matter of months before the EU and the UK introduced their windfall taxes on renewables generators, denying investors the certainty, stability, predictability they needed, as Iberdrola's Galán saw it, the US, of course, had passed the Inflation Reduction Act, granting renewables developers another 10 years of generous tax credits. If anywhere in the global north now looked decidedly better from the perspective of expected profits than it previously had done, then it was the US, not Europe. Galán said precisely as much to the Financial Times. Although Europe, in his view, had been ahead of the US in driving decarbonization to that historical point, the balance had shifted in 2022, with Europe's interventions being likely, he argued, to stunt renewables investment while the US's own legislation had made it, by contrast, a very much more attractive place to invest. Iberdrola, Galán said, would be revising its investment priorities accordingly. The US government took longer to take the climate change theme seriously, he maintained. But now they are committed to it. They are putting in all the necessary support. 68 Indeed, in early 2023, it was reported that US economic officials were stepping up efforts to lure European clean energy businesses across the Atlantic, touring Europe in delegations and armed with details of subsidies offered by the Inflation Reduction Act. 69. And in any event, it is quite clear that in 2022, as, of course, had been true historically, not remotely as much capital was going into renewables investment in Europe as could have been the case, and, doubtless, would have been the case, if profit prospects had in fact been positive. To demonstrate this, One need only consider briefly the example of the European oil and gas majors, led by the UK's BP and Shell. In 2020, as national governments around the world increasingly made pledges to transition national economies to net zero within the coming decades, both companies similarly pledged to substantially reduce the emissions for which they are directly or indirectly responsible. The principal way they would do so, they said, was by scaling up renewable energy production while scaling back fossil fuel production, thus giving themselves a new raison d'etre for the post-carbon economy. 70. Fast forward to 2022, and the opportunity to begin to make good on this pledge was, on the face of things, perfect. Soaring oil and gas prices meant that BP and Shell were generating unprecedented profits. They were also under increasing pressure from activists, governments, and even formerly indulgent bodies such as the IEA not to reinvest these profits in their core hydrocarbon business, pressure that, in the case of governments in the UK and the EU, materialized partly in the shape of windfall fossil fuel taxes. In short, the time could not have been better for BP and Shell to make the strategic pivot they had promised, to start walking the renewables walk as well as talking the talk, and, in the process, to secure a viable business model for the long term. If profit opportunities in renewable energy generation had indeed looked strong to their analysts, we can be as sure as night follows day that the two firms would have grasped the nettle then and there. But they did not. They failed dismally, effectively turning their noses up at the strategic opportunity that their hydrocarbon windfalls had, fortuitously, conferred upon them. Both chose, instead, principally to use the vast surplus capital freshly at their disposal to return money to shareholders via dividends or share buybacks, with BP, one research group calculated, spending more than 14 times as much on such payouts in 2022 as on low-carbon capital expenditure. 71. The same research group found that the ratio was nominally lower at Shell, just 7.5 times. But another research organization alleged that much of the spending by Shell's Renewables and Energy Solutions division in fact had nothing to do with renewables at all. 72. Globally, just 1% of the oil and gas industry's cash spending in the pivotal, crisis-racked year that was 2022 went on investment in low-carbon technologies. 73. Even the Financial Times, normally reluctant to pass judgment of any kind on capital allocation, editorialized that the European oil majors' puny investment in renewables represented a clear case of underspending. 74. In the energy world, estimating underlying rates of profitability is always a difficult business. What appears to be a relatively profitable sector may, in reality, be a sector which is perennially dogged by intense competition and low profits, but in which government intervention such as subsidies of various kinds serves broadly to maintain returns at levels that secure ongoing investment, thereby muddying underlying economic dynamics. Renewable electricity generation, this book has claimed, approximates relatively closely to such a hypothetical sector. But, based on the data alone, it is difficult to be completely sure. The investment behavior of the European oil and gas majors in 2022, however, arguably provides about as much certainty on this matter as we can have or would likely ever need. Definitive proof of poor underlying returns in renewables is probably impossible, given the ubiquity of external support. Yet, if anyone were looking for such definitive proof, the majors' categorical snubbing of renewables when drowning in free cash flow in 2022 was surely it. Saving the planet, they were telling the world, is just not profitable enough for us. Among others, the Financial Times was paying attention, and it understood the significance. This, it soberly remarked, does not bode well. 75. 7. Periods of crisis are typically times of ferment in ideas as well as practice. New questions get raised as new issues arise and new challenges are posed. Meanwhile, old questions tend to resurface, as the realization dawns that old answers, and the institutional and organizational orthodoxies they seeded, no longer appear to be adequate, if, indeed, they ever were. From Texas to China and from Pakistan to Portugal, The rolling electricity crises of 2021-3 have been no different in this regard. Commentators, policymakers, and industry participants have grappled with all manner of vexing questions. Some of these have, of course, been of the here and now variety. Where can we buy the necessary fuel to keep our power plants running this winter? Can surging wholesale and retail electricity prices be moderated, and, indeed, should they be? Why are we exporting electricity to other countries when demand can barely be satisfied at home? Alongside such urgent questions, however, we have seen questions of a more fundamental nature increasingly being asked. These have been concerned less with dealing with the present crisis than with averting the likelihood of more crises further down the road, or indeed with addressing long-standing crisis tendencies that short-term emergencies may have led the world to neglect. Should we continue the process of unbundling, privatizing, demonopolizing and marketizing our electricity sectors? Is a method of pricing in which the price of natural gas ordinarily determines system-wide electricity prices the right one for a decarbonizing world? How can decarbonization and energy security best be reconciled in the long term? Whatever the territorial scope, the meta-questions effectively being asked in all such instances are, in essence, the following: is our electricity system fit for purpose? Is it actually going to get us where we need to go? If not, can it be modified to make it shipshape? Or is a more radical overhaul required? It is to these critical questions, of a more fundamental nature, that we turn now, in the book's final chapter. 11. Roads to Nowhere. Established in 2005 as a wholly owned, pure energy trading business by the global financial institution Bear Stearns, Bear Energy gained effective control of its first power generation assets the following year. It did so by entering so-called tolling agreements for approximately 6 GW of fossil fuel-based generating capacity in the western and northeastern U.S. owned by the New York-based LS Power Group. Under a tolling agreement, a firm, Bear Energy in this case, pays a rent to the owner of a generating plant, in return for which it secures the right to purchase fuel for the plant and sell its electricity output. In 2007, Bear Energy took control of substantial further generating capacity when, for around $500 million, it acquired several tolling contracts from the Oklahoma-based energy company Williams. Among these was an agreement covering the output of certain gas-fired plants in California owned by another U.S. energy firm, the AES Corporation. These plants could collectively produce about 4,000 MW of electricity, and were thus known as the AES 4000 units. In 2008, at the height of the global financial crisis, Bear Stearns famously collapsed. Much better known for its securities brokerage and investment banking operations, Bear Stearns's energy business has barely merited a footnote in the vast commentary that the financial crisis, and Bear's role in it, subsequently elicited. Nevertheless, Bear Energy's assets, its tolling agreements included, passed into the hands of a new owner when Bear Stearns was sold in May 2008 in an emergency deal brokered by the Federal Reserve Bank of New York. Bear's new owner was J.P. Morgan Chase, another global financial institution. What had been Bear Energy was folded into J.P. Morgan Chase's own energy subsidiary, namely J.P. Morgan Ventures Energy Corporation, itself originally founded, like Bear Energy, to trade energy commodities. The tolling agreements for the AES gas-fired plants that JPMVEC inherited in 2008 extended through 2018 and required it to pay AES a total annual rent of $170 million. In the event, however, JPMVEC did not actually get to sell the electricity generated by the AES 4000 units until several years later. The reason was that, shortly prior to its parent company failing, Bear Energy had retold its rights to those plants to one of California's primary electricity supply companies, Southern California Edison. SCE would hand back responsibility for the plants to JPMVEC on a rolling basis, beginning with 4 plants at the start of 2011, followed by 6 more at the start of 2012. Partly to develop experience with the business of electricity generation, to which it was new. Before retaking control of the AES 4,000 units, JPMVEC acquired short-term rights to 2 other California plants from January 2010. For 8 months, these 2 plants then ran at a consistent loss, with large demand payments on the one hand and only infrequent dispatch, and hence little revenue, on the other. But JPMVEC was evidently quick to learn. In October of that year, it began to use a new bid strategy for HB3 and 4, which proved highly profitable. 1. The team that developed this strategy, JPMVEC's Principal Investments Unit, calculated that were the same bid strategy to be implemented at all the AES plants in California as and when they returned to the firm's control, those plants would earn JPMVEC estimated profits of $1.5 billion to $2 billion through 2018. 2. Principal Investments, it seemed, had managed to turn dirt into gold. JPMVEC did not get to see this plan all the way through, however. In 2011, the operator of the Californian wholesale electricity market referred JPMVEC to the Federal Energy Regulatory Commission on suspicion of improper bidding practices. Focusing mainly on the AES plants newly controlled by JPMVEC, FERC conducted investigations both that year and in 2012. In 2013 it delivered its ruling. JPMVEC, it concluded, had indeed gamed the market. Specifically, it had violated the Commission's anti-manipulation rule. And it had clearly done so highly profitably. In addition to a civil penalty of $285 million, JPMVEC agreed to disgorge alleged unjust profits of $125 million. 3. And that, in short, was basically that for J.P. Morgan Chase and the business of electricity generation. FERC handed JPMVEC a 6-month suspension of its market-based rate authority. Meanwhile, the bank announced it would be exiting physical wholesale power selling altogether. It started by handing the tolling agreements for AES's California plants back to SCE, this time through a sale, estimated to be worth around $750 million, rather than a sublease. To paraphrase Brian Burrow and John Heliar, the financial barbarians had been shown to the energy market's exit gate. 4. While it is vital for any number of reasons not to be excessively pessimistic about humanity's prospects of keeping global warming to a broadly tolerable level, it is also vital to be realistic and to face facts. For all the impressive-sounding rhetoric at the 26th United Nations Climate Change Conference in 2021, for example, it is striking that what the UN Environment Programme labels the emissions gap, the gap between greenhouse gas emissions reductions promised and the emissions reductions needed to achieve the 1.5 degrees Celsius temperature goal of the Paris Agreement, remains essentially as large as ever. Immense, was the adjective used by UNEP in its October 2022 update. Specifically, UNEP estimated that this gap would amount to 23 gigatons of CO2 equivalent annually as of 2030. 5. What was particularly depressing was that, fully a year on from 26 Colombian pesos, revisions to countries' emissions pledges, their so-called nationally determined contributions, had served to reduce the estimated emissions gap for 2030 by only a paltry 0.5 GTCO2e. As things stand, these pledges have set the world on track for estimated warming of approximately 2.8 degrees Celsius by 2100.6. And all this is before even raising the question of whether countries will actually make good on their pledges, which, UNEP observed, they presently are not remotely on course to do. Thus, in addition to the aforementioned emissions gap, UNEP also estimates an implementation gap, representing the difference between projected emissions under current policies and projected emissions under full implementation of countries' NDCs. This gap, too, is yawningly large, likewise measuring in gigatons of CO2 equivalent. In a sobering article published upon the release of the UNEP update, The Economist noted comparable findings from Systems Change Lab, a conglomerate of environmental organizations and think tanks. 7 The latter's State of Climate Action 2022 report identified 40 key emissions indicators, for example, the amount of CO2 generated per unit of steel produced, and a 2030 target for each that must be met if the Paris pathway is to be achieved. The Economist was interested in the question of how many of these 40 were on track for 1.5 degrees Celsius. The answer? Not a single one of them. Indeed, 5, it learned, were heading in the wrong direction entirely. In other words, there are essentially two connected problems. One is that we, collectively at the global level, are not being ambitious enough in our objectives for cutting emissions. The other is that we are not currently doing enough to make the achievement even of these inadequate objectives credible. We are, in other words, utterly failing. Of course, not all of this, by any means, has to do with electricity and our failure to decarbonize its generation as rapidly and comprehensively as is required. In fact, The Economist argued in the article referred to above that if there was a glimmer of hope, it was that the burning of fossil fuels, responsible for around 3/4 of global anthropogenic emissions of CO2, which in turn represent around 3/4 of all global anthropogenic greenhouse gas emissions, had risen only marginally in 2022, thanks, in no small part, to growth in solar and wind power. And the IEA, in its turn, was positively bullish when updating its forecasts for renewables in December 2022.8. Its new report heralded the largest ever upward revision of the IEA's renewables numbers, projected global renewables capacity growth of 2,400 GW between 2022 and 2027, almost entirely concentrated in wind and solar, was some 30% or higher than it had forecast just a year earlier. Renewables, the IEA said, were now the only electricity generation source whose share was expected to grow. Nonetheless, electricity generation demonstrably remains the nub of the climate change problem. It is, as we saw in Chapter 1, the single largest source of global anthropogenic CO2 emissions. Moreover, to ensure that the brutal truth is not obscured, we can and should, when assessing the scope of the problem, essentially set aside positive data and estimates concerning solar and wind power. This is not to say that such positive data and estimates are not relevant and promising, they clearly are. But solar and wind power do not produce CO2. The burning of fossil fuels to generate electricity produces CO2, and it is entirely possible for solar and wind capacity and generation to grow at hitherto unprecedented rates, while harmful emissions from fossil fuel-based electricity production themselves also still continue to escalate. The fact that solar and wind-based electricity is growing in absolute terms does not mean that dirty electricity generation is not also doing so. Indeed, even if renewables are the only source to grow their proportional share of overall generation, as the IEA says will likely be the case in future, it is still possible for other sources to grow in absolute terms, if overall global demand for electricity is itself growing fast enough. The all-important metric, then, is not renewable electricity capacity or generation, but fossil fuel-based electricity generation. We should not let apparent good news stories about the former blind us to facts about the latter. It is fossil fuel-based electricity generation that, one way or another, has to end. And, if the volume of such generation grows, the problem we face, the thing that must be eradicated, is getting bigger, not smaller, however well we seem to be doing on the renewables front. And this is exactly what is still happening. The stark reality, as Figure 11.1 shows, is that, during the past 2 decades, electricity generation from fossil fuels has consistently been increasing, interrupted by only short periods of substantive decline associated with the global financial crisis and the COVID-19 pandemic. Even in 2022, the latest year for which we have data, in which The Economist saw its glimmer of hope and during which Europe was forced to contend largely without Russian gas, our key metric registered yet another increase. That year, global electricity generation from fossil fuels totaled around 17,400 TWh, which was nearly double what it had been 2 decades earlier. Such generation was also on average more carbon-intensive than in 2021, due to a relative substitution of coal for gas in Asia and Europe. Not only are we failing in the pivotal domain that is electricity production, then, but the scale of our failure, captured in the lengthening bars in figure 11.1, continues, seemingly inexorably, to grow. Figure 11.1 Global electricity generation from fossil fuels, 1993 to 2022. Source, Our World in Data. As we saw in Chapter 1, and should remind ourselves here, the geography of this global predicament is enormously significant. The main reason why global emissions from electricity generation continue to grow as much as they do is that the countries in which growth in electricity demand has latterly been concentrated rely overwhelmingly on fossil fuels to produce power. In large part, this is a story about China and India. These two have in recent years typically accounted between them for around 4/5 of global annual growth in electricity consumption. It is true, as we have repeatedly seen in this book, that both, and especially China, have made great progress in installing solar and wind capacity. But there remain significant headwinds to such progress. Having said in early 2021 that renewables would provide for 2/3 of the country's increase in electricity consumption through 2025, for example, China, as recently as mid-2022, substantively moderated this target, lowering it to 50%. Around the same time, amid the country's continuing energy crisis, China's government laid out a plan to add 300 million tons of new coal production capacity. 9 The reality is that, in both China and India, notwithstanding all the progress on renewables that has indeed been made, electricity generation remains extremely dirty, with fossil fuels presently supplying around 2/3 of electricity in China and around 3/4 in India. Moreover, with only a handful of exceptions, China and India themselves being prominent among them, the countries that continue to add most new renewables capacity are Western countries, in which future growth in electricity demand is expected to be relatively modest by global standards. To be sure, Europe and the US will need more electricity as they proceed with the electrification of transport, buildings, heating, and so on. But these increases, while material, nevertheless will be almost as nothing compared with those predicted for many countries in Africa and Asia, in which the electrification of currently non-electric sectors such as transport will widely go hand in hand with ongoing developments that, as the 20th century experiences of Europe and the US can themselves attest, will also drive significant growth in electricity consumption. Foremost among such developments are population growth, industrialization, urbanization and, last but not least, the introduction of electricity to significant numbers of households that historically have not had access to it. Policymakers and grid operators in countries such as the US often become exercised when contemplating the fact that national electricity demand will potentially double or treble by mid-century, which is a reasonable enough standpoint. But try to consider things for a moment from the perspective of their counterparts in countries such as Bangladesh, Egypt, Indonesia, Nigeria, and South Africa. Bangladesh's population, for example, is expected to grow by another 20% or so, to around 200 million, by 2050. Meanwhile, a recent study projected that per capita electricity demand in Bangladesh will be some 22 times higher in 2050 than it was in 2014.10. Now that, one might say, is what a real challenge looks like. Almost without exception, these expected territorial focal points of future global growth in electricity consumption are both heavily reliant on fossil fuels for existing power generation and are decarbonizing such generation at an extremely slow pace, if at all. It is a toxic combination, illustrated with striking clarity in Figure 11.2. Figure 11.2 Share of electricity production from fossil fuels, selected countries, 2017 to 21. Source, Our World in Data. Needless to say, none of this is about finger-pointing. As is well recognized, the countries in question have made only trivial contributions to the vast amounts of greenhouse gases currently lodged in the atmosphere, for which Europe and the US are overwhelmingly responsible. Neither should we forget that such countries' efforts to decarbonize, efforts that, as this book has shown, are always and everywhere as much about financial wherewithal as about political ambition and technical capability, are being pursued within the context of political economies that are post-colonial only partly in reality, and, at least as much, merely in name. Chronic debt burdens and fiscal incapacity have been the trademark colonial legacy. When the cost of finance for new renewables projects is around 9 to 10% or as it is in, say, India, political ambition and technical capability can only get you so far. 11 The stark, incontestable reality is that, as things stand, in countries such as those referenced in Figure 11.2, it is not just difficult but more or less impossible for new renewables projects to turn a profit unless their financing is heavily subsidized. Utility-scale solar, confirms Teal Emery, is unviable at market interest rates in lower-income countries and is not being built. 12 That less than 1% of the $434 billion invested globally in clean power projects in 2021 went to Africa is explicable only with direct reference to punitive capital costs and their rooting in historically overdetermined political economic inequalities within and between nations. 13 It is little wonder that Derek Brower, outgoing U.S. energy editor at the Financial Times, recently expressed astonishment that anyone still questions the idea that the Western nations that did so much of the damage will have to finance the transition in the developing world. 14. So, no, this is not finger-pointing, at least, not in the direction of poor countries seemingly lumbered with fossil fuels. The point, rather, is that organizations such as the IEA can celebrate all they like Western policy breakthroughs such as the US Inflation Reduction Act of 2022, and the expected positive impact of such breakthroughs on domestic renewables growth. But, increasingly, the developments that really matter to global electricity sector emissions will be ones occurring elsewhere in the world, and as the IEA's own executive director, Fatih Birol, himself has conceded, it more and more looks to be the case that poor countries with fossil fuel-heavy electricity sectors, in which, the IEA says, investment in clean energy must rise a staggering sevenfold within 7 years if climate goals and energy demand are to be met, are in fact being left behind in the global energy transition. 15. 2. From China to India, Nigeria, and beyond, one common trend that we have observed at various points in this book is that, in different ways, at different speeds and with varying degrees of success, policymakers in such non-Western countries are attempting to move their electricity sectors in broadly the same direction that Western countries, especially in Europe, have previously taken. We examine the core components of this prototypically Western sectoral model in Chapter 2. It necessitates unbundling of vertically integrated operations. It entails, where possible, but especially in generation, the introduction of competition. It means more private ownership of operating assets. And, perhaps most challengingly of all, it means markets, in both electricity wholesale and retail. The reasons for pursuing this model are as varied as the routes to its achievement, but one key rationale looms large in most places. That is, governments regard privatization and marketization, in particular, as a means to the putatively desirable end of reducing both state funding and involvement in the electricity sector. Of course, such views have hardly materialized out of thin air. Neoliberal ideologues, purveyors of the so-called Washington Consensus, at institutions such as the International Monetary Fund have long told non-Western policymakers that this is exactly how they should regard electricity privatization and marketization. Furthermore, fiscal constraints, often fashioned by the very same ideologues, have widely given impetus to attempts to restructure electricity sectors along such privatized and marketized lines. The sharp increase in sovereign financing costs worldwide since late 2021 has only added to such impetus. Yet it should be abundantly clear to readers, by this point in the book, that there is a considerable irony about all this, not least, though not only, in terms specifically of renewables. For as we have repeatedly seen, the the reality of the electricity industry in places where the sector has been substantially restructured along the lines being pursued today in many non-Western territories is actually very different from the model that is rhetorically presented as being the objective and the end point of such reform. Government financial support and active involvement in the electricity sector are in fact arguably no less integral in substantially restructured and liberalized contexts than they are elsewhere. Even before the energy crisis of 2021-2, for example, more than half of the countries in the EU, the very home, materially and symbolically, of marketized electricity, had some form of retail price control. And, everywhere, the development of renewables remains propped up by government support. It surely cannot have escaped the notice of policymakers elsewhere in the world that in 2022, the US, of all places, extended explicit and substantial government financial support for the private sector development of solar and wind power for another entire decade. The ubiquity of such government support should be a crucial consideration when thinking through arguments about how electricity sectors around the world might best be reconfigured to accelerate processes of decarbonization while keeping, or making, power affordable to users. The fact that governments have generally been unable safely to remove mechanisms of support for renewables, even with the costs of the underlying technologies having fallen as far as they have, does not necessarily tell us what roads should be taken. But it does help provide clarity on what roads probably should not. Clearly, the answer is not for governments to do what they long presumed they would be able to do once the cost of generating electricity renewably had fallen to levels comparable with the cost of fossil fuel-based power, which is to say, to remove support. This, naturally, has been the approach advocated by free marketeers all along. Philip Booth of the UK's Institute of Economic Affairs, for instance, articulated this position several years ago, and the position has not changed. What he called green groups support renewable subsidies, Booth wrote, because such subsidies increase demand for renewables compared with carbon-intensive energy production. However, he maintained, this approach is mistaken. 16. Why? Renewables, Booth claimed, do not have a negative social cost that would justify a subsidy. At best, they have a zero social benefit or cost. The neutral position is not to tax or subsidize them any more than any other product or service is taxed or subsidized. But what about the pesky matter of carbon and climate? Some, but presumably not Booth himself, would, he admitted, argue that renewables may have lower social costs than carbon-intensive energy forms. But that, he insisted, is an argument for taxing carbon-intensive energy forms and not for subsidizing renewables. Interestingly, parts of the left have, in recent years, formulated arguments about government support for the private sector development of renewables that appear to come to the same conclusion about the merits of such support, even as they operate from very different principles and postulates, and even as they possess very different views on what roads to future energy infrastructure provision the world should in fact be taking. Such left critics, too, are hostile to the feed-in tariffs, tax credits and the like that governments serially extend to renewables developers. If, however, for Booth and others on the free market right the objection to subsidies is that they obscure price signals and generate inefficient outcomes, the left's objection, by contrast, is that, by de-risking private sector investment, the state socializes risk, financial and non-financial, while guaranteeing and inflating private gain. 17. Yet such left objections to de-risking are not particularly helpful. If the problem as it is indeed de-risking, the answer, we are told, either explicitly or implicitly, is for the state not to de-risk, just as Booth at the Institute of Economic Affairs would have it. But what then? Unless the state were successfully to arrogate to itself the job of developing, financing, owning and operating renewable energy infrastructure, or were willing and able widely to compel private sector actors to invest in the development of such infrastructure against their own volition, it is hard to see what good would come of a refusal to de-risk. The unspoken assumption in the left critique of de-risking seems to be that such de-risking is unnecessary. Remove the government support mechanisms, the logic evidently runs, and the private sector will continue to invest regardless, even if the available profits might be lower than they would otherwise be. If that is not in fact the assumption, then the question surely arises of what such critics would make of the inevitable decline in renewables investment that would occur were mechanisms of de-risking cut short. If this book has shown us anything, however, it is that government support to renewables development is not unnecessary. At least where markets for the commercialization of renewably generated electricity output are structured in the ways they currently are, both in the global south and across the global north, de-risking is more or less essential inasmuch as the revenue risks are otherwise too substantial to enable affordable private financing. To suggest otherwise is to dismiss what we actually know about the economics of the electricity business. If anyone tells you that de-risking is not necessary, the greatest trick the private sector ever pulled, even, then refer them to the experience of the UK's onshore wind sector in 2018 or Vietnam's solar sector in 2021. Of course, this is not to suggest that de-risking in practice is unproblematic. On the contrary, from the perspective of concerns such as those around justice, equity, and public sector institutional capacity building, external support to private sector renewables development clearly can be less or more problematic, and to widely varying degrees, in terms, for example, of what types of bodies shoulder the de-risking burden and how risk and reward are actually apportioned. To say that de-risking of renewables remains broadly necessary within the global business of electric power as currently constituted is not to say that it is always effected in desirable ways. Nevertheless, it is probably worth posing the matter in the stark terms demanded by the climate crisis. What is the greater risk we face? Is it states continuing financially to support private sector renewables development, and thereby continuing to pad investor returns? Or is it states not deigning to de-risk, and potentially seeing renewables development, for as long as it is something expected principally of private sector actors, wither on the vine? 3. An end to government support was not necessarily their recommended solution, but even before the global energy crisis of 2021 to put some of the problems associated with liberalized, capital-centric Western electricity systems under the spotlight, many mainstream organizations and commentators were already arguing that such systems were no longer fit for purpose, if, indeed, they ever had been. Both the growing significance, in practice, of renewable sources of electricity generation, and the growing importance in policy of optimizing conditions for further renewables development, have long been pivotal to such concerns about inherited, liberalized systems. The central point that has been made is that electricity systems as they exist today in places such as Europe and the US were designed and built in and for a fossil fuel world. As such, the argument runs, the systems in question are optimal neither to encouraging the development of renewable power nor to enabling its production and consumption once installed. This critique has always been partly about engineering issues, about the fact that, bluntly stated, our transmission and distribution networks were, in Gil Plimer's words, generally engineered physically to serve large coal-powered plants. Dispersed renewables developments such as solar and wind farms. 18 But, more than that, the critique has been about economic issues. That is to say, our complex institutional arrangements for translating the physical generation and delivery of electric power into a series of interconnected revenues and costs earned and borne respectively by different actors, have, the critics maintain, also always been, and remain, intrinsically fossil fuel-based systems. Energy economists were the first to make this case. Thus, as early as a decade ago, Malcolm Key, John Rees and David Robinson, emblematically, had this to say about the electricity business: existing markets are designed around the characteristics of fossil generation but are not so well adapted to the newer entrants. Such markets, they went on to observe, themselves remain in essence unreformed, an observation that is as true today as it was when they made it. The problem, as they therefore saw it, is that markets as they exist were not designed to, and do not, reflect the cost structures and operating characteristics of the growing new energy sources. 19. In time, this would become more or less orthodoxy within the mainstream of energy economics opinion. By 2017, for example, The Economist, picking up on important developments within the scholarly literature, was also convinced of the case for changing the way the world buys, sells, values and regulates electricity to take account of the new means by which it generates it. 20 By early 2021, even the IEA, scarcely a revolutionary organization, was willing to accept that the existing rules for electricity commercialization in liberalized markets probably did need ripping up. If the share of renewables in the electricity generation mix is to rise as envisioned in the net zero emissions by 2050 scenario, it would, the IEA maintained, be highly desirable to effect significant changes in the design of electricity markets so as to provide signals for investment. 21. That economists and those institutions substantially guided by economists should come to these views about the deficiencies of existing forms of market organization is unsurprising. Much of this book, after all, has been about highlighting outcomes of the maladaptive contemporary political economy of electricity that, in many cases, it would be a stretch even for those who are relatively invested in the existing scheme of things to consider beneficial or satisfactory. Perhaps the most obvious of these deleterious outcomes is the simple fact that, as and where governments have sought to reduce or remove support for renewables, developers and, in particular, their financiers have shown almost no inclination to take on merchant price risk. If this implies that the market, under its existing constitution, will always be stuck on support, then no wonder there have been growing calls to reform it. As we saw in Chapter 6, the volatility of liberalized electricity spot markets is generally anathema to the banks that finance wind and solar plants. It is true, as one equity investor has observed, that certain debt funds are starting to offer pretty flexible debt instruments based on a long-term merchant production profile. 22 But what that investor failed to mention was the onerous terms that such flexibility always entails. As José Donoso of the Spanish Solar Association UNEF has noted of the Spanish renewables landscape, for example, when lenders do finance merchant projects, they require around twice the share of equity financing compared to subsidized projects. 23 Providers of funding on terms that developers are actually comfortable with accommodating are, as the aforementioned investor conceded, still struggling with full merchant exposure, and the struggle looks set to continue. 24. And so we remain in a paradoxical world that seems, at least, ripe for reform. The economists and economic commentators mentioned above do not quite put it in these terms, but the reality today in liberalized electricity systems such as Europe's is that, to secure financing, renewables developers ordinarily do everything they can, whether it be through feed-in tariffs, corporate power purchase agreements or financial hedges, to avoid selling their output at the market price. This, in fact, is arguably the market's signal feature, a form, if you like, of categorical negation. We have a market that perversely requires certain increasingly significant participants to systematically evade its own price signals. Thus a head of steam for reform was certainly already building momentum well in advance of the global energy crisis. In the UK, for instance, to take just one example, influential mainstream experts were calling for sweeping market reform from as early as the mid-2010s. Particularly vocal on this front was the Oxford energy economist Dieter Helm, whose 2017 Cost of Energy Review, commissioned by the government, laid out a whole series of reform recommendations. What the crisis of 2021-2 did was redouble the momentum, particularly in Europe. 25 If, prior to 2022, European policymakers, at least those who actually listened to the likes of Helm, had been dimly aware of problems with the existing ways in which electricity was bought and sold, they had also been able collectively to bury their heads in the sand inasmuch as the system of provision continued broadly to function, even if idiosyncratically and clearly far from optimally, and inasmuch also as renewables penetration continued broadly to rise. Burying their heads, then, is what such policymakers had been doing, to the exasperation of Helm and legion other economic advisors. But, in 2022, denial was no longer an option. That it was specifically in the spring of 2022, as electricity prices soared across Europe in the wake of Russia's invasion of Ukraine, that the UK, for example, finally launched its long-awaited review of electricity market arrangements, was hardly coincidental. As The Economist had presciently said in 2017, although voters give little thought to electricity markets when they are working, they can get angry when prices rise. And they scream blue murder when the lights go out. 26. Prices were indeed now rising, and sharply, and attention became focused on precisely why. The answer, as we have seen, had much to do with the disproportionate impact of gas prices, themselves spiking, on electricity prices in Europe's wholesale markets. All of a sudden, the merit order was a topic of everyday conversation rather than an esoteric nugget of energy economics. As rising gas prices pushed up the price of electricity produced by all generators, whether gas-fired or not, the gap between the average cost of electricity generation to its producer and the average price of that electricity to wholesale market purchasers, and ultimately to users, widened. Short-term fixes to high electricity prices, those discussed in Chapter 10, could not do much about these underlying market mechanisms. But more fundamental, longer-term reforms potentially could and, policymakers now promised, eventually would. Decoupling gas and electricity prices thence became a political clarion call, nothing less than a sine qua non, European publics were told, of market restructuring. Unsurprisingly, the most vocal advocates of such decoupling came from those European countries in which gas contributes only a relatively small share of electricity, and thus in which the disproportionate impact of gas prices on electricity prices seems particularly incongruous, and even unfair. France, where nuclear dominates, was one. Spain, where renewables supply nearly half of all electricity, was another. All manner of proposals for such reform have been and continue to be circulated. One is to split the market, and to price renewable electricity differently from fossil fuel-based electricity. Another suggestion is to use an average cost of generation, a sort of throwback to pricing models prior to the liberalization of the 1990s, or to pay generators the average bid. A third is to pay each generator what it bids, rather than the single market clearing price. And in countries, like the UK, where geographically differentiated pricing is not currently used, introducing such locational pricing is regarded by some as a potentially propitious alternative, although the fact that countries that do price in this manner, such as Sweden, did not escape the electricity market carnage of 2021-2, should clearly give pause. To some eyes, no doubt, such proposals, these have been the most commonly and widely propounded, would likely appear positively transformative. But, before proceeding further, we should be clear about one thing. All these proposals are firmly couched within a framework that a priori assumes that electricity continues to be something bought and sold in markets, and predominantly by private sector actors. The aim shared by such proposals, in short, is to make markets work better, to extend and fine-tune existing processes of marketization, and not anything more radical than that. 27. 4. What to make of these various proposals for market reform? 28. All, it is clear, have likely drawbacks. Costly generators would make losses under average pricing, yet are sometimes needed to keep the lights on, The Economist noted. Paying what is bid could give generators an incentive to inflate their bids. Localized pricing, meanwhile, might skew generators' decisions on where to build capacity. And the radical option of splitting the market into two, one for renewable power and one for fossil fuel-based power? Insofar as most renewables generators avail themselves of mechanisms of price stabilization, and insofar as the price of much renewable power is therefore already effectively fixed, the option of splitting the market, according to experts such as Rahmat Pudina of the Oxford Institute for Energy Studies, doesn't make sense. 29. The Economist seemingly shared this skepticism. In fact, the more that commentators at the leading mainstream chronicles of Western capitalism such as The Economist and the Financial Times contemplated the disarray in European and global electricity markets during 2021-2, the more skeptical they evidently became about the prospect of root and branch electricity market reform in general. It is true, such commentators conceded, that high electricity prices, the source of so much consternation during the period in question, are clearly in many respects a problem. But low electricity prices, they sought to remind readers, are actually not unproblematic themselves, and especially not, it was argued, when it comes to the crucial matter of incentivizing the further development of renewable power. 30 Doubtless mindful of the ever-present specter of price cannibalization, The Economist, citing the energy scholar Francis O'Sullivan, had noted in as early as 2017 the inherent tendency for solar power under merit order dispatch to eat its own tail or cannibalize its own competitiveness away. Commentators now actively highlighted the spur that relatively high electricity prices, underpinned by the existing market designs, could theoretically provide to decarbonization. 31. Writing in August 2022, for example, Sam Fleming and Valentina Popp of the Financial Times observed that Europe's existing system of electricity pricing provides the basis for future investments in renewables and other power infrastructure. 32 Shortly afterwards, writing this time with Alice Hancock and Tom Wilson, Fleming expanded on this argument, adding that herein lay some of the traditional reluctance among European policymakers to rip up the institutional status quo. Historically, the three reporters wrote, there was little desire to overhaul the system, even as the proportion of clean power in the energy mix increased. It was hoped that higher wholesale electricity prices would incentivize the development of green energy by increasing the profit margin for lower-cost renewables projects. 33. Amid the growing calls for fundamental reform of European electricity markets that reverberated around the continent in 2022, therefore, The Economist and the Financial Times, such important weather vanes of informed mainstream political economic orthodoxy, increasingly sounded notes of caution. Don't throw the baby out with the bathwater, was effectively their message. We might end up with something worse. Needless to say, these publications were not alone in urging policymakers to retain faith in the existing system design, or at least to think extremely long and hard before jettisoning it. Energy companies that benefit handsomely from that system understandably were also keen to emphasize the putative positive role of its design in encouraging ongoing renewables growth. Talking about reworking the electricity market, said Ørsted's Ulrik Stridbæk, is the wrong thinking at a very critical moment. 34 When, a few months later, the government of Denmark, Ørsted's home territory, floated the idea of the state taking stakes in future offshore wind farms, opposition parties retorted with the same objection as had Stridbæk. Why fix what is not broken? We don't understand what problem you want to solve with public ownership, said Samira Nawat of the Social Liberal Party, given the market works satisfactorily. 35. Meanwhile, regulatory bodies charged with administering Europe's energy markets, and which in many cases have long been prone to capture by the very companies they are meant to regulate, have also, equally predictably, proven to be conservative voices, similarly preaching prudence and caution. Nowhere was this clearer than in the case of the EU Agency for the Cooperation of Energy Regulators. In April 2022, as momentum for reform was building, ACER swiftly issued a report warning against tearing up existing market structures. 36 It repeated its warning in January 2023, again invoking opportunistically the inviolability of the right investment signals for all the new build necessary to carry our very accelerated and ambitious energy transition. 37 Little wonder, then, that when the European Commission did eventually deliver a firm proposal for electricity market reform in March 2023, it was a damp squib, containing nothing by way of fundamental redesign, and certainly not the modification of spot market price formation that had been widely promised. If the likes of The Economist and the Financial Times were not the only members of the chorus to voice warnings about market reform, they were the most noteworthy. They are, after all, independent of industry interests, if not necessarily of political economic dogma. More importantly, perhaps, they had themselves, at least in the case of the former publication, been among those who only a few years previously had seemingly been convinced that fundamental reform was required. As we saw earlier, The Economist had explicitly called for changing the way the world buys, sells, values and regulates electricity. What is particularly notable about the back and forth in thinking about electricity market design exhibited in recent times by magazines and newspapers such as The Economist and the Financial Times, fully in favor of an overhaul 1 year, reluctant to countenance such reform just a few years later, is not so much the specificities of the various recommendations that happen to have been made at one point or another. Rather, what stands out is the principal wider meta-conclusion about electricity markets that the commentators themselves have drawn from their own analytical vacillation. The Economist's writers appear already to have had a hazy sense of this meta-conclusion well in advance of the ructions of 2021-2. Getting renewables to today's relatively modest level of penetration was hard and very expensive work, they wrote in 2017 in an article devoted to the question of market design. To get to systems where renewables supply 80% or more of customers' electricity needs, they reckoned, at a time when very few others would have agreed, will bring challenges that may be far greater, even though, they added, in a throwaway remark whose actual significance this book has endeavored to bring home to us, renewables are becoming comparatively cheap. 38. Over the following years, and especially once the crisis that began in 2021 was in motion, it became clearer still what the upshot of all this was. Evidently, the main, overarching conclusion to be drawn was, simply stated, the following: none of this is easy. If, for instance, low electricity prices are a problem, but high prices are too, and if the apparent logic of wholesale market reform can strike analysts as compelling at one juncture but strike the same analysts as anything but certain at a later point in time, then there can, it was intuited, be only one reasonable deduction. The problem, in short, The Economist had concluded by September 2022, is that designing an electricity market is hard. 39. V. The Economist identified a number of reasons for this difficulty in designing an electricity market. Among them were the following. The juice cannot yet be stored at scale, and has to be delivered at the exact moment it is needed. Producers need to spend a lot of money upfront to build a windmill or power plant, and need to be able to recover it and make a profit over decades. Climate change policies dictate that more and more renewable electricity is fed into the system, despite being mostly at the whim of wind and sunshine. 40. There is, it should be said, nothing substantive to quibble with in this. Everything in that paragraph is true, at least if one takes as read the necessity of profit-making. And, yet, reading this text and others like it concerning the legion difficulties involved in fashioning a functioning market in electricity, it is difficult to avoid the sense of commentators not seeing the forest for the trees. Or, to use a different metaphor, the sense is of commentators identifying the mice in the room, but failing to spot the elephant. Such accounts steadfastly refuse to countenance what is, actually, a much more obvious explanation for the difficulty of designing an electricity market featuring producers consistently able to make a profit. What is that explanation? That electricity essentially was and is not a suitable object for marketization and profit generation in the first place. To the extent that this alternative explanation holds, it is not only more obvious than the various explanations proffered by The Economist and the like, but also more fundamental. It is the meta-explanation, as it were, that underlies all others. Let us briefly consider such an explanation conceptually. A helpful touchstone in this regard is the work of the economic anthropologist Karl Polanyi. Writing in the 1940s, Polanyi argued that in capitalism there are real commodities and what he called fictitious commodities. 41. A real commodity, he said, was something that was originally brought into being explicitly for sale on the market. Commoditization, in other words, was intrinsic to it. Commodities were fictitious, by contrast, if they were treated by society as commodities by being bought and sold in markets, but had not been created with such commoditization in mind. Rather, the market had subsequently been imposed upon them. Fictitious commodities, Polanyi pointed out, are typically awkward, unruly things from a capitalist market perspective. Not being originated for markets, marketization does not come naturally to them. When society goes about treating such things as commodities by buying and selling them, therefore, they seem to resist such efforts, and all manner of difficulties tend to arise which one typically does not encounter in the case of real commodities. The result, Polanyi observed, is that in order for markets in fictitious commodities ever to cohere and function, various props, rules, regulations, and norms must be fashioned and applied. These serve to make it appear like what exists is a real market, featuring real prices and actors earning real profits. But this is always a fiction, a kind of pretense. Prices and profits in such cases are always as much a matter of external institutional intervention as of supply and demand, and all market actors are party to the collective fiction, participating in it with varying degrees of awareness. Polanyi claimed that there were three such fictional commodities: land, labor, and money. But, on his terms, electricity absolutely is one too. Never mind the fact that electrical energy occurs naturally, as in lightning. Scholars who have undertaken research into the historical origins of the industry that ultimately developed around humanly produced electricity have shown that commoditization occurred only haltingly and contingently. Here is obviously not the place to go into that history in any detail, but a particularly salient fact is that, for many years, it was far from clear that electricity itself, that is, the producible energy form that is bought and sold as kilowatt-hours today, would eventually emerge as the principal locus of commoditization. 42 More generally, as Simon Pirani has observed, in most times and places around the world since its invention, humanly produced electricity has been regarded more as essential infrastructure, or a means of social provision, than as a business. 43 A commodity by its nature, electricity is not. The point of relevance for us is that, as we have seen in this book, there is ample evidence of various props, rules, regulations, and norms being required to render electricity buyable and sellable at profit, that is, to tame its unruliness and render it commodity-like, and to sustain the fiction that all of this somehow represents real profit in a real market. Yet it plainly does not represent such. Few have made this point more powerfully than Meredith Angwin, who had the following to say about the electricity markets that have been created in those parts of the U.S. where vertical unbundling and demonopolization have occurred. They are not markets as we know markets. They are complex systems, with new regulations constantly tweaking and trying to improve existing regulations. They are a bureaucratic thicket, not a market. It's Orwellian. Deregulated only if deregulated actually means lots more regulation. War is peace. Deregulation is lots more regulation. Orwell would be amused. 44. Consider, for instance, the profits of renewables generators. Nothing could be more unnatural, as Polanyi would have seen it. Certainly, the profits are real in the sense that they represent revenues less costs. But more than anything else perhaps, they are the product of continual, ongoing and, ultimately, rather haphazard efforts by policymakers to keep that magical financial output, revenues less costs, within what is best conceived as a zone of reasonableness. If profits are too low, developers will not invest; too high, and critics will cry foul. Thus policymakers are forever in the position of needing to pull one of two levers: subsidies and other support mechanisms to enable profits when they are scarce, windfall taxes to cap them when they become abundant. As for the market, the fact that state intervention and support, not least, though not only, with regard to renewables, are endemic is the very least of the reasons to view electricity through a Polanyian lens. After all, this market's signal feature in the age of climate crisis is, as we saw earlier, that the hallowed market price, which theoretically congeals all relevant information and sends signals to actors as to how to respond, is the one price that renewables operators endeavor not to sell at. It would be hard to imagine stronger refutation of Acer's risible claim, at the height of Europe's energy crisis, that, under normal conditions, the continent's electricity markets work well. 45. Perhaps Polanyi's sharpest insight of all, however, was that maintenance of the fiction that a thing such as land or labor is genuinely amenable to commoditization ultimately depends on major market actors abiding by norms and conventions that are fragile even under relatively benign conditions. In other words, it is crucial that actors with the power to make or break brittle markets contribute to the collective fiction of commoditization by behaving in a conventional manner. The market edifice, or artifice, depends upon such observance of the formal and informal codes that scaffold markets in fictitious commodities. The risk, of course, is that someone comes along who is not party to these codes, or who simply does not care about maintaining the pretense, and who proceeds to blow the fiction apart. And this, it turns out, is exactly what happened when J.P. Morgan Chase entered the business of electricity generation in 2010. 6. It will be recalled from the beginning of the chapter that, in 2013, Chase's energy arm JPMVEC was found to have earned over $100 million in unjust profits from its control of various power plants, including the AES 4000 units in California inherited from Bear Stearns. It had amassed these profits in a short space of time. To do so, it transpired, it used various strategies for bidding the output of the plants into California's wholesale electricity market, adopting different such strategies for different plants at different times. Though the strategies certainly varied, we can illuminate the basic principle animating each of them by exploring the simplest, labeled Strategy B in FERC's analysis of the case. 46. To understand Strategy B, there are some important contextual considerations, beginning with the nature of the plants where JPMVEC used it. These, Alamitos 3 and 4, two of the AES 4000 units, were hugely inefficient gas-fired facilities built in the post-war era. Their inefficiency manifested in two main ways. One was an operating cost that was typically higher than the spot market price, which itself averaged about $30 to $35 per MWh during the period in question. 47. The other was a slow ramp rate, meaning that the plants could only gradually increase or decrease their output. Crucially, wholesale market operators such as California's endeavor to respect such physical limitations in giving contract awards to power plants. Strategy B expertly exploited these factors. For every third hour, JPMVEC submitted a so-called self-schedule for AL3 and 4. This is a price-taker bid, meaning the generator accepts whatever price is set by the market, say $30 per MWh in our example. For the 2 hours in between, however, JPMVEC submitted bids with much higher prices, between $73 and $98 per MWh. Needless to say, for the hours when the plants were price takers, their bids were accepted. But what of the intervening hours? One might assume that with market prices being $30 to $35 per MWh and the bids being above $70, the bids would be rejected, being well out of merit. But no. FERC explained why not. CAISO's software needed to take into account the fact that just as cars can only accelerate or brake at a certain rate, a power plant can only increase or decrease its output at a certain speed. In the intervening hours to respect the unit's ramp rates that JPMVEC had registered with CAISO. 48. In short, JPMVEC was paid the market price for every third hour, while being paid as bid, which is to say at between $73 and $98 per MWh, for the intervening hours. And this was how the strategy generated vast profits. The electricity that the AL3 and 4 plants generated and sold every third hour was unprofitable, because the market price was below the plant's operating costs. But the electricity the plants generated and sold in the hours in between was highly profitable, because the bid price, $73 to $98 per MWh, was significantly above operating cost. Of course, Stories such as this are usually narrated as morality tales about malevolent financiers engaging in manipulation, deceit, fraud, or all three. And this was certainly how FERC sought to present the matter publicly. But the story is much better read as an allegory about fictitious commodities. To render a commodity out of the unruly object that is electricity, market makers and regulators such as CAISO and FERC have had to fashion all manner of guidelines, norms and conventions. In turn, to enable the production and reproduction of markets in said commodity, the same institutions have serially depended on market actors respectfully observing those guidelines, norms, and conventions. J.P. Morgan Chase, however, signally did not respectfully observe. Chief among the core conventions in a spot market such as CAISO's is the principle that conventional generators bid at the marginal cost of production, which is to say the cost of generating an extra unit of power. Indeed, the idea of marginal cost pricing is so ingrained in the episteme and regulation of merit order-based markets that the theory, that this is how conventional generators rationally should bid, is frequently mistaken for the reality. Even the economist, usually so informed, gets this wrong. Suppliers bid, it recently explained to readers, according to how much it would cost to provide an extra unit of power, known as its marginal cost 49. But it is simply not true. Regulators and economists certainly assume that this is in fact how conventional generators bid. More importantly still, the integrity of markets such as CAISO's substantially depends upon such generators bidding in this way. Had JPMVEC done so at all times, of course, its bids ordinarily would not have been accepted. Based on their costs, FERC lamented, as if in mitigation of being gamed, the units were typically out of the money 50. Yet the theory is not the reality. As FERC quietly conceded, the prices that generators submit are not required to be at marginal cost. 51 They are not required to be, and yet it is essentially taken on faith that they will be. J.P. Morgan Chase, though, effectively laughed in the face of such faith. To hell with that, it essentially said. We are allowed to bid however we like, and so we will. Isn't this supposed to be capitalism? This perhaps is the nub of the matter. What the bankers broke was convention rather than rules. As Matt Levine wrote, in a typically astute commentary, there was no lying, or need for lying, about what happened. This is not like Libor, where you had to affirmatively lie. Here J.P. Morgan just followed the rules, simply and literally, but they followed them to places they were not meant to go. 52. The reason why J.P. Morgan's actions were so threatening to FERC and the rest of the industry establishment is that they rattled the market facade, the notion that a functional market in electricity is indeed possible because electricity is indeed a reasonable thing to be bought and sold in markets. FERC and the US-grid operators had built what Levine witheringly described as a dumb system that rewarded a modicum of perfectly transparent gamesmanship. To be sure, J.P. Morgan Chase did not play the game according to established norms, but it did play by the rules, just as all the generators briefly earning $9,000 per MWh in Texas in February 2021 did. To treat this case as being about bankers' ethics, therefore, would be to overlook the much more important and interesting lesson it delivered about the marketization of electricity, namely that the market per se is a dumb, ill-equipped system for electricity provision, reliant for its successful operation upon, inter alia, strictly conformist behavior from participants. One might protest that the case was a one-off, and an extreme one at that. But it was not, nothing could be further from the truth. By 2013, the designers and custodians of electricity markets in the US and worldwide had had decades of experience in building and operating such markets, punctuated by numerous previous cases of market manipulation, Enron, anyone. From which to learn about design faults, and thus ample opportunity to perfect market mechanisms, were it the case that such mechanisms were indeed perfectible. 53. Furthermore, it is not like JPMVEC unearthed just one minor loophole in an otherwise watertight system. FERC found that JPMVEC had manipulated the market, a market essentially the same in its constitution as those found in restructured electricity sectors elsewhere in the world, using no fewer than 12 different bidding strategies. 54 FERC's analysis of the case almost made it sound like it was harder for market participants to successfully observe market conventions than not to. Did the case lead to the world's experts patching remaining holes and finally getting electricity market design right, at least in terms of immunity from manipulation? Of course not. Polanyi's teaching is that an infallible market in a fictitious commodity is a contradiction in terms. Just 3 years later, for example, on the other side of the Atlantic, the UK power generator Intergen successfully misled National Grid system operator into paying millions more than it needed to for electricity generated by the company. Suffice to say, on the reading of the UK's industry regulator, Ofgem, the breach in question demonstrated not the inherent incongruity of a market in electricity, but rather idiosyncratic weaknesses in Intergen's procedures, management systems, and internal controls. 55. Then, in 2023, reporters for Bloomberg unearthed an even bigger and wider case of apparent manipulation of Britain's wholesale electricity market. 56 Several conventional generators had been achieving huge profits by engaging in so-called on-supply gaming, essentially, claiming an inability to deliver in the day-ahead market, which serves to push wholesale prices up, only then to actually deliver, and thereby exploit those inflated prices, in the real-time balancing market. As in the case of JPMVEC and California, such gaming did not contravene existing market rules. It was considered, rather, ungentlemanly. Meanwhile, Ofgem added to the picture of absurdity by sending letters to the responsible companies asking them kindly to stop. 57 Polanyi, one imagines, would be wearing a wry smile at the thought. Notably, these latest UK revelations were published the very same month as the European Commission, similarly fighting a long-standing losing battle, published a proposal for improving the protection against manipulation of its own wholesale electricity markets. 58. Needless to say, the startling thing about all this is that policymakers evidently still believe, or at least pretend still to believe, that they actually can consummate the market. They cannot. As long as electricity continues to be bought and sold in markets, such cases will perforce remain endemic, because a better example than electricity of an awkward fictitious commodity, stubbornly confounding efforts to construct a sound market around it, it would, we can perhaps agree, be hard to find. The particular value of the J.P. Morgan story, then, is as a cautionary tale, precisely at a time when the mainstream consensus in places such as Europe is that the answer to deficiencies with electricity markets, the grievance of the hour happening to be the deleterious coupling of electricity prices to gas prices, is not something other than markets, but rather markets of a slightly different and better hue than we presently have. To imagine that this is indeed the answer is to ignore all the accumulated evidence around us about what kind of commodity electricity is, and about the myriad contortions perennially required to effect a market for its delivery and to stabilize at a reasonable level that mysterious thing we call profit. Markets never will cohere naturally and unproblematically in this setting. Doing the same thing over and over again and expecting different results may not always amount to insanity, but nonetheless, attempts to reform and improve the electricity market are doomed, and, as the climate crisis escalates, such attempts summon a mishmash of fearful metaphorical imagery. Roads to Nowhere is certainly one such image. Fiddling while Rome burns might be more apposite yet. 7. Not everyone, of course, believes that capital and the market, in either its existing shape or suitably reformed, are going to get us where we need to go in terms of electricity decarbonization. Throughout the past few decades of increasing awareness that electricity generation must be rid of fossil fuels, there have been those who insist that sticking with a model that a priori prioritizes markets and the private sector is the wrong approach. Their voices have been growing in number, volume, and pitch in recent years. They have also, notably, been growing in range. If the proposition that markets and the private sector will not themselves successfully decarbonize global electricity within a reasonable time frame was once the preserve of political economic radicals, that is clearly no longer the case. Said proposition has, for example, been appearing with increasing frequency in the pages of the Financial Times, no less. The private sector alone will not deliver the energy transition, wrote Nick Butler, who had worked at BP for the best part of 3 decades, in 2019.59. Capitalism won't deliver the energy transition fast enough, Derek Brower has more recently concurred. There's too much to do, and given the urgency and the need to get the solution right, this isn't a task for your favorite ESG-focused portfolio manager or the tech brothers. The sheer scale of the physical infrastructure that must be revamped, demolished, or replaced is almost beyond comprehension. 60. For such disputants, a massively expanded role for the state is typically the answer. Governments, not BlackRock, will have to lead this new Marshall Plan. And keep doing it, insisted Brower. 61. Not only, critics of status quo approaches say, should the state invest heavily in new renewable energy capacity, but, many argue, it should also nationalize existing privately owned electricity generation assets, whether green or brown, thereby giving it considerable power to control output and prices rather than leaving production and pricing to the fate of private and market forces. Part of the logic of this standpoint is that, as we have seen at length in this book, the state is in fact already deeply implicated in the project of electricity decarbonization. Through renewables capacity auctions and feed-in tariffs and the like, it plays a fundamental role not just in shaping the pace and form of decarbonization, but also in funding it. Only it typically does not own and control the assets and income streams that eventuate, it takes the risks, actively removing them from the shoulders of reluctant developers and financiers, yet seldom gets any of the pecuniary rewards. If the state is already doing so much, and paying so much, to drive electricity decarbonization, does it not make sense? Critics of electricity's current political economic configuration have long asked, that the financial and operational ledger should be evened up. There is, of course, an obvious potential third way of sorts, somewhere between decentralized markets and capital holding sway at one end of the political economic spectrum, and, at the other end, control and ownership by the centralized state. Instead of through the proprietary development, ownership, and operation of power generation assets, governments could in theory substantially hasten and scale up the shift to renewable energy by compelling capitalists to invest more and faster in renewables, even as, in view of profitability concerns, they choose not to. Like the public ownership approach, this, too, would be very much a state-led transition, but the state would effect the transition by ordering rather than doing. In one sense, this third way could be seen as a mere variation on what already happens. To get capital to invest, the state would simply be wielding sticks rather than offering carrots, would it not? But there is no simply about it. To oblige private sector actors to do what they do not want to do, which would amount to taking the existing capital and markets orthodoxy and jettisoning the markets component, would surely be a bridge too far for any major national government of the contemporary era, right or left. The industrial policy of picking winners, firmly back in fashion since the coronavirus pandemic, is one thing, forced investment is another thing entirely. To pursue it on a massive scale would be tantamount to publicly asserting that there is in fact nothing free about free markets. If, therefore, the state is ever to step up to the plate in driving rapid power decarbonization in more substantive and meaningful fashion than it is presently doing, extensive public ownership of renewable energy assets appears the most viable model. Indeed, it is more or less inevitable that, among the various constituencies that could potentially take ownership, figuratively and literally, of our collective energy future, the state is ordinarily regarded as the best alternative to the default existing combination of markets and private firms. If not markets and the private sector, then who, other than the state, could possibly undertake the necessary transformative project? Local community or distributed development, ownership, and control of renewable resources is all well and good, but it is fanciful to imagine that it can ever be the main answer to the challenge, especially given the speed and scale at which electricity decarbonization is required. Beyond capital, only the state, by which I mean national governments considered collectively, potentially has both the financial wherewithal and the logistical and administrative capacity rapidly to lift annual global investment in solar and wind capacity from a few hundreds of billions of dollars to substantially in excess of 1 trillion, and then keep it there, which, of course, is not to say that this would be anything other than a monumental political and economic task even for state institutions to achieve. Moreover, as numerous scholars have pointed out, the state taking a leading role in owning and controlling renewables energy infrastructure does not necessarily mean other actors, from the private sector to community groups, taking no role. Instead of crowding out such alternative investment, public direct investment can just as easily crowd it in. 62. The exemplar of this vision of state leadership and ownership of renewable electricity generation is the so-called Green New Deal. Though it comes in various recommended guises, all of them frame the GND as a modern, green successor program to the original New Deal, which entailed a vast program of national infrastructure renewal in the U.S. in the mid-1930s designed to drag the country out of the depths of the Great Depression, and in which almost all the new infrastructure was funded and owned publicly. Notably, public ownership specifically of renewable energy has been the kernel of all significant contemporary GND proposals, including both that on which the UK Labour Party campaigned in the 2019 general election, and that on which Bernie Sanders campaigned for the US Democrats' presidential nomination the following year. Generally, the main argument that GND-type proposals have marshaled in favor of state ownership and control of relevant infrastructure, and, no less explicitly, against a capital-centric model hinging on markets and private actors, has been an essentially Keynesian one. Given the scope and ambition of these proposals, this makes perfect sense. Though renewable electricity generation certainly is at their substantive core, such proposals are per se concerned with system transformation on a much broader, society-wide level, and hence the sheer scale and complexity of the transformational challenge tends to be the overriding consideration. Keynes's thought is particularly enlightening in this regard. If, after Polanyi, a profit and market-centered model is inappropriate to the relatively simple proposition of delivering a single fictitious commodity such as electricity, it is manifestly more inappropriate still when society is faced with the prospect of transforming, quickly, seamlessly, and comprehensively, a whole complex system of social and economic life. As Keynes argued, market signals fail when it is the case that numerous different actors need to make coordinated changes and yet none can take all others' choices as given. Only a central decision maker, Keynes's successors insist, can hope to bring about such coordinated, collective transformation in a timely and effective manner. The interlocking matrix of changes required of innumerable stakeholders by the climate crisis is a quintessential example of a transformation of this type. 63. In other words, the arguments underpinning GND and similar macro proposals for state ownership and control of climate-relevant infrastructure generally are not the argument that this book has made about capital's difficulty with electricity decarbonization, an argument that is fundamentally about profit. This does not mean that I disagree with those arguments, nor that they are incompatible with the thesis that uncertain or unappetizing profitability prospects widely militate against the faster private sector build-out of renewables. It simply means that this book has made a different, if complementary, case. Now, critical interventions that are focused specifically and more narrowly on renewable energy generation, and which argue in favor of public ownership of this particular activity, do sometimes touch on the question of profitability. But here is the curious thing. They usually, though not always, argue the case back to front. The state should build, own and control wind and solar farms, purveyors of this argument propose, precisely because this is putatively a highly profitable activity, and not because, in fact, it is not. To take a recent instructive example, consider the proposal by the UK Labour Party, the leadership of which has passed from Jeremy Corbyn to the more centrist Keir Starmer since the GND-inspired 2019 election campaign, to launch a publicly owned renewable energy generation company, called Great British Energy, if it were to win power. GBE, Labour has said, would enable the UK government to reduce household electricity bills because the profits presently being siphoned off by private renewables generators would be socialised instead. Indeed, in support of its proposal, Labour invoked a 2022 report by the Trades Union Congress that attacked the excess profits taken by privatised electricity generators, not least in renewable sectors such as fixed offshore wind with, in the TUC's words, known profitability. 64 The TUC had estimated that the excess profits that a public energy champion such as Labour's proposed GBE would be able to capture were equivalent to some £2,250 to £4,400 per UK household. Such claims, this book suggests, betray a deep and perilous misunderstanding of the economics of renewable energy, and of the weak and uncertain profitability that actually plagues the sector. 8. If, therefore, the case is going to be made for the state substantially arrogating renewable energy generation to itself in order to drive electricity decarbonization, and if that case is going to draw on arguments about industry profitability, then it will need to be very different from the one propounded by the UK Labour Party. Its core logic would presumably be that the state needs to drive electricity decarbonization more actively, directly, and proprietorially than it currently does because the anticipated profits available from renewable energy generation are in fact not sufficiently attractive to incentivize the private sector to pursue decarbonization quickly and comprehensively. It was, therefore, a particularly noteworthy political development that took place in the U.S. state of New York in 2021. That year, a small coalition of lawmakers introduced a bill designed to transform the state's existing institutional landscape of electricity generation. The bill was called the Build Public Renewables Act. Its aim was to precipitate rapid decarbonization of the state's power generation infrastructure by enabling and requiring the public sector itself to build out solar and wind power in the state at scale. The impetus was the state's ambitious 2019 Climate Leadership and Community Protection Act, which set targets for 70% of the state's electricity to be renewably generated by 2030, and for generation to be wholly carbon-free by 2040. The state is home to the largest publicly owned utility in the country, the New York Power Authority. Yet, as of 2021, the NYPA was restricted by its charter from owning or building new utility-scale renewable generation projects. The BPRA sought to strike down this restriction and compel the NYPA to develop its own solar and wind farms. Not only was the introduction of the BPRA arguably the boldest substantive legislative proposal for publicly owned solar and wind power in the US history, but the logic underlying it happened to be the exact inverse of the flawed logic underlying UK Labour's GBE proposal the following year. To wit, the bill's sponsors worried not that private firms were swimming in renewables profits, but that they were not. Assembly member Bobby Carroll, for example, one of the bill's co-sponsors, made this particular point in the following terms when interviewed in 2022 by Kate Aronoff. 65 If we're going to meet our climate goals, Carroll began, we need the state to play a large role. The reason? We're not just going to hope the market decides a certain project is bondable and profitable and thus will go forward. For that way, reckoned Carroll, lay only failure, the targets set in 2019 would inevitably be missed. The same view was held by the environmental campaigners who, in 2021, enthusiastically took up the cudgels and, for 2 years, fought doggedly for the BPRA to be passed. If profit expectations were the sole determinant of whether, where and when solar and wind farms were to be built, New York State's climate ambitions would be thwarted. The campaigners' conviction, in Grace Ashford's words, was that in order to meet the electricity needs of the state, projects will need to be undertaken in locations that are unattractive or unprofitable for private industry. 66 Carroll had come to the same conclusion, his summation being one that in fact could very well serve as a reasonable synopsis for the book you have been reading. There are a lot of projects, Carroll said, that I don't think will ever get built if we rely solely on a profit-driven model. 67 Indeed not in the US, and not elsewhere in the world either. Riffing on Carroll, A slightly fuller and more precise synopsis of this book might read as follows: if private capital, circulating in markets, is still failing to decarbonize global electricity generation sufficiently rapidly, even with all the support it has gotten and is getting from governments, and even with technology costs having fallen as far and as fast as they have, it is surely as clear a sign as possible that capital is not designed to do the job. And so, in the shape both of the thesis of this book, and evidently also the thinking of those behind the BPRA, we have what is in fact a relatively atypical rationale for public infrastructure ownership. From this standpoint, the reason for favoring public ownership would not be, as it so often is, objection to rampant private sector profiteering. It would be the opposite. Our position would be that the private sector needs to be stripped of responsibility for renewable energy generation, because renewable energy generation is not, or is not typically expected to be, consistently profitable enough for the private sector to develop it as urgently and massively as we need. Furthermore, the BPRA holds up a mirror to our wider story in another important way. The bill failed to pass in legislative session both in 2021 and in 2022. Hopes were especially high in the latter year, when it sailed through the state Senate. But Carl Hesty, Speaker of the State Assembly, stonewalled it by refusing to bring it to a vote. This difficulty should not surprise us. The death of the neoliberal faith in capital and markets has been pronounced too many times to remember in recent years, but the faith remains strong where it counts. In the face of all the evidence to the contrary, Germany's finance minister, Christian Lindner, for instance, was shameless enough to write in the Financial Times in early 2023 that the European and global energy crisis had served to confirm the effectiveness of a market-based approach to energy supply, and served, for good measure, to show that we should also rely on price signals when it comes to reducing CO2 emissions. 68 In New York State, the BPRA was up against not only relatively robust such faith in markets and the profit motive, but also determined organizational lobbying. 69. This decisive combination of factors had, of course, been enough already in the US to see off the prospect nationally of a meaningful Green New Deal. President Biden's climate-focused Inflation Reduction Act of August 2022 was, in reality, a pale imitation of the vision on which Sanders had campaigned 2 years previously, a dwarf GND, as one commentator has felicitously put it. 70. Meanwhile, across the world, renewables continue to substitute for conventional generating sources far, far too slowly. Given everything we have learned, the fact that China continues to be easily the main driver of such renewables growth as is occurring should be no more surprising to us than the political resistance in the US to the BPRA. One does not in any way have to be an admirer of China's political economy to acknowledge that, as Michael Davidson has pointed out, while Western policymakers, including those holding the reins of power in New York State, remain broadly convinced that they really do possess only one trick, namely deference to capital and the price mechanism, markets represent just one tool among many available to Beijing. 71. Even as the BPRA's difficulties should not surprise us, however, they should certainly worry us. This, after all, was not a red state like Kentucky, West Virginia, or Wyoming. This was New York, and as Aronoff emphasized, Hesty was not a Republican firebrand, he is a Democrat, and the fight over the BPRA that raged for 2 years from 2021 was a battle among Democrats. In short, in New York, the political stars were arguably as propitiously aligned as they ever will be for BPRA-type legislation that is designed to shift renewable energy provision in the Western world away from its current capital-centric configuration. And then, in May 2023, a breakthrough of sorts. The campaigning had finally borne fruit. New York legislators passed a state budget that incorporated what was, essentially, a watered-down, compromise version of the original BPRA's core demand. It will require the NYPA to build, own and operate new renewable generation capacity, but only if the private sector indeed fails, as Carroll predicted it will, to keep the state on track to achieve the targets for renewables penetration laid out in the 2019 legislation. How this 2023 New York budget item might be read by those in the wider world who are convinced of the need for substantially greater public ownership of renewable power will likely depend largely on whether they incline to seeing the proverbial glass as half empty or half full. Those of the former tendency would probably point to what happened in New York and say that if it took so much hard work, in such ideal conditions, to achieve a relatively modest victory for publicly owned renewable power, what realistic chance is there further afield, on a bigger scale, for an energy transition that is not capital and market-led and hence not perennially hamstrung by the profit imperative and the developmental limitations it imposes? Those accustomed to taking a more optimistic view would likely scoff at this. Look at New York, they would say, and feast your eyes on a world of newfound political, economic, and environmental possibility. Time will tell which camp has it right.